au droit de la main de l'ennemi. Et le grand Goliath se retrouve par terre. Lui seul me suffit. J'aimerais entendre la foule. Lui seul est tout pour moi. Ah, je ne sais comment. Je me mets à chanter l'Éternel. Éternel est bon. Éternel est bon. Et mon âme t'adore. Et mon âme te loue. Car nul n'est comme toi. C'est un chant nouveau qui monte dans mon cœur, un cantique d'amour pour mon seul sauveur. Tu m'as pris de loin, tu m'as lavé, je t'ai placé à tes côtés. Je n'ai plus peur de rien, je ne crains plus rien, car le bon berger est de mon côté. Et même le ténèbre n'ont plus aucun pouvoir sur moi. À la clé de l'amour, c'est mon papa qui la tient. Quand il te tient la main, tu fonces au droit de la main de l'ennemi. Et le grand Goliath se retrouve par terre. Lui seul me suffit. J'aimerais entendre la foule. Lui seul est tout pour moi. Ah, je ne sais comment. Je me mets à chanter l'Éternel. Éternel est bon. Éternel est bon. Et mon âme t'adore. Et mon âme te loue. Car nul n'est comme toi. C'est un chant nouveau qui monte dans mon cœur, un cantique d'amour pour mon seul sauveur. Tu m'as pris de loin, tu m'as lavé, je t'ai placé à tes côtés. Je n'ai plus peur de rien, je ne crains plus rien, car le bon berger est de mon côté. Et même le ténèbre n'ont plus aucun pouvoir sur moi. À la clé de l'amour, c'est mon papa qui la tient. Quand il te tient la main, tu fonces de l'ennemi. Et le grand Goliath se retrouve par terre. Lui seul me suffit. J'aimerais entendre la foule. Lui seul est tout pour moi. Ah, je ne sais comment.
Good morning, everybody. Mrs. Secretary of State, Chairman of the Board of ATIDI, Mr. the CEO of ATIDI, the Board of Directors of ATIDI, members of the Diplomatic Corps, shareholders, distinguished guests, ladies and gentlemen, bon dia à todos, bonjour à tous et à tous, good morning, everybody, and be very welcome to the third and final day of ATIDI's 25th Annual General Meetings right here in Luanda, capital of one of Africa's fastest growing economies. Over the past 2 days, we've exchanged bold ideas, forged new partnerships, and laid the groundwork for a more connected, confident, and capital-strong Africa. And today we bring it all together. We shift into action, sharpening our focus on how we reduce the cost of capital and unlock new pathways for financing growth across our continent. And to officially open this morning's program, it is my absolute pleasure to welcome on stage the Chief Executive Officer of ATIDI, Mr. Manuel Moses. Round of applause for Mr. Moses.
Good. As usual, when I get to the stage, the mic has to be adjusted for height. So, Your Excellency Josiane Cristiano de Souza, ladies and gentlemen, honorable distinguished guests, members of the media, ladies and gentlemen, bon dia. I am so happy. It's my privilege and a pleasure to the 12th annual ATIDI Investor Roundtable here in Luanda, Angola. Let me begin by extending our sincere thanks to the government of the Republic of Angola for graciously hosting this year's event and for your continued commitment to regional integration, economic transformation, and your partnership with ATIDI. It is truly wonderful to be here in this vibrant city. And as someone named Manuel, I always say I was destined to come home and to feel home here in Angola. Even my name sounds local. I wish I could speak a little bit more Portuguese. I look forward to this important conversation ahead and to the new connections that we will build as we work together to unlock the potential of our beloved continent. Since its inception, ATIDI has grown from a monoline political risk insurer into a comprehensive provider of risk mitigation solutions. Today, our offerings extend well beyond political risk to include credit insurance, the Regional Utility Support Facility, RLSF, the support for SMEs under our COSA initiative, and many more. This evolution reflects our responsiveness to challenging priorities that our member states and private sector demand. As at the end of 2024, ATIDI had facilitated over $88 billion in trade and investments across the continent, which is a clear demonstration of the impact and the well-structured risk, what the impact of well-structured risk mitigation tools can do in unlocking the potential of our continent. Despite the progress made, we remain acutely aware of the scale and the challenge ahead of us. Africa continues to attract less than 4% of global foreign direct investment, as we call it FDI, with a significant concentration in extractives and infrastructure, leaving many sectors underserved. This is precisely why we are here at this investor roundtable sessions, so that we can explore through this platform how to broaden investments across the landscape, channel investments into the diverse areas and potentials that we have. This year's theme, which is turning risk into opportunity, securing a sustainable future, captures the very essence of ATIDI's mission. Our role goes beyond underwriting risk, enabling solutions, but by transforming ambition into bankable outcomes. We help to unlock progress that improves lives, drives prosperity, and secures Africa's long-term development path. As we turn into today's discussions, our panels will delve into critical issues shaping Africa's investment landscape and the macro economic forces that are at play. The structural reforms that are needed and local capital at scale. In our first panel, we will explore Africa's macroeconomic outlook, rising premiums, and the persistent challenges across affordable capital to access affordable capital. The second panel will focus on the foundational elements that build investor confidence, including regulatory capital market development, and the role of blended finance. Countries like Angola have made commendable progress in modernizing financial governance. However, across the continent, regulatory fragmentation and the lack of sharing mechanisms continue to limit the flow of capital. This is where instruments such as insurance wraps, credit enhancement, structured finance solutions like those offered by ATIDI must be mainstream to help close the bankability gap and mobilize funds and scale across Africa. Angola holds a unique and a valued place in ATIDI's membership. As a nation growing regional influence, a reform-oriented government, and a strong commitment to investment-led development, Angola is shaping Africa's future. A powerful example is the Beta project. This is the water supply project, which was a landmark for ATIDI, valued at 1.1 billion, aimed at delivering sustainable drinking water to nearly 2 million residents in the province of Luanda. ATIDI's risk mitigation solution support was instrumental in unlocking long-term concessional funding for this transformational project. It stands as a clear demonstration of what it means to de-risk development, making essential infrastructure projects bankable and accessible and resilient. There could be many more examples coming out of these panels. Looking ahead, ATIDI is eager to support Angola's broader infrastructure and regional integration ambitions, particularly the transformative Lobito corridor. The multi-country initiative holds immense promise to boost trade, catalyze industrial growth, and generate employment across the strategic economic corridor linking Angola, Zambia, and the DRC. The goals of the Lobito corridor strongly align with ATIDI's mandate, and we are actively engaging with the public and the private sector partners on how insurance solutions, credit enhancements, and digital tools can help build this vision into a sustainable reality. Africa's future will not be built through risk aversion, but through bold informed and strategic investment with risk. It is time to reframe the perspective, to see risk not as a barrier, but as a catalyst for innovation, collaboration, and long-term value creation. This is the very foundation on which ATIDI was established, to turn risk into opportunity to help Africa's achieve its full investment potential. True strength of this roundtable lies in the diversity of thought, experience, and perspectives gathered here today, those in the room and those who are online. By harnessing this collective insight, we can chart a path that strengthens sovereign resilience, unlocks private sector potential, and lays the foundation for a sustainable and prosperous Africa. Muitos obrigado. Thank you very much.
Thank you very much, Mr. Moses. Or shall I say, muito obrigada, Senhor Manuel. Now I will only address you in Portuguese. Thank you very much for such a powerful address and also this strong call to action to get into full gear and unlock the potential of our continent in a sustainable and bold way. And now it is my great honor to invite to the stage the Secretary of State for Budget of the Republic of Angola, Mrs. Jussiane de Souza, representing this morning the Honorable Minister of Finance of the Republic of Angola. Let's all welcome Mrs. de Souza very warmly.
Excelentíssimos, Excellencies, members of ATIDI, distinguished guests, ladies and gentlemen, good morning. On behalf of the government of Angola, it is an honor for me to welcome you to Luanda for the Roundtable of Investors and high-level sessions of the 25th AGM of ATIDI. It is a privilege to welcome this high-level meeting dedicated to promotion related to risk protection and sustainable development of our continent. Angola lives today a transformative dynamic in its economy by structures of investors and transformation marked by economic reform, renewed investor confidence, and commitment to regional collaboration. This year's theme, turning risk into opportunity, securing a sustainable future, could not be more timely or relevant. It reflects the critical role that organizations like ATIDI play in helping African nations address uncertainty, unlock investment capital, and accelerate inclusive sustainable growth. For over 2 decades, ATIDI has supported trade, investment, and infrastructure development across the continent by offering tailored risk mitigation solutions, from political risk insurance to credit enhancement, aligned with Africa's evolving development needs. Ladies and gentlemen, the investment environment across the continent is becoming increasingly complex. Global risk aversion, limited liquidity, and climate-related shocks are covering with long-standing structural challenges. In this context, risk mitigation is no longer a niche instrument. It has become as central to how development is financed. Organizations like ATIDI play a crucial role, not only by providing insurance coverage, but by reframing the conversation, demonstrating how tools such as insurance wraps, guarantees, and blended finance structures can reshape project outcomes. As we gather here today for the Investor Roundtable and boardroom sessions, we stand as a pivotal moment for our continent. The conversations taking place are not only timely but essential as they focus on how we can manage risk more intelligently, attract sustainable capital, and drive inclusive growth across Africa. The of development, commercial banks and private sector investors are important for the creation of sustainable progress that was mentioned previously. Angola is proud to host this platform and to contribute for a shared vision of economic transformation. I invite all participants to take use or advantage of this space to build points between ambition and concretization. We are grateful for your presence in our country and for your continued commitment to the future of Africa. Thank you.
Another big round of applause for Mrs. the Secretary of State. Muito obrigada, excelente.
Thank you very much, Secretary of State, for your intervention and a reminder that the future of Africa is being built with a vision and courage. Thank you once again.
Transition into the first high-level discussion of the day, a roundtable that will explore the macroeconomic landscape, the risk premium in African markets, and what it will take to shift perceptions and unlock greater investment flows into the continent. And to guide us through this crucial discussion, I'm absolutely delighted to hand over to someone who knows the terrain, I want to say, inside out. Please, let's all welcome the Managing Director of African Business, Mr. Omar Ben Yedder.
Thank you, Anne-Marie, and good morning all. My name is Omar Ben Yedder. I'm the publisher at African Business Magazine. I'll be the facilitator rather than a moderator. Today's roundtable discussion really is exactly what it says. It's a discussion with all of you. So we're going to have a presentation to set out a macroeconomic perspective of where we are today and some of the headwind risks that one is facing. And then we're going to have some lead discussants setting the scene before opening up the floor for comments, and feel free to challenge what's been said, feel free to compliment what's been said. So someone once told me that life is unfair and you don't get what you deserve, you get what you negotiate. So what we're here to do is actually improve the conditions so that we can negotiate better and strengthen our bargaining position. A golfer also once said that the harder I work, the luckier I get. And really, we're here to all work together and in a collaborative fashion to bring together solutions that will ultimately help reduce the cost of capital and increase capital flow to the continent. I think those are the two overriding objectives of the discussions. So the minister yesterday said that risk is ever present and we can't get rid of risk. But she said three things. She said risk needs to be understood, which is what we're here to do today. And we'll have, again, that presentation from Gabrielle Reed, Head of Advisory at Pangea Risk, to help us understand what the risks are today and what those mean for the continent. She said that risk needs to be shared. I think that's what ATIDI is trying to do by sharing the risk, but sharing risk that is understood and managed wisely. So again, what we'll want to know is how are you managing risk? How are you taking your clients to the market, and how is the market responding to those risks? So I think yesterday there were other calls for actions in terms of being enablers of confidence, which again we'll have Samira Mensah, who's the managing director at S&P Global, who'll be able to tell us the fundamentals of African risks and ultimately how we can create greater confidence in the market. Bold thinking, agility, and unity of purpose. We've got Shwan beside me here from Lazare, who's a sovereign advisor. We've also got Takunda from Rand Merchant Bank. So they'll tell us about some of the innovations in the market that are taking place and some of the thinking around the instruments that they're putting out there and some of the solutions and structures that are working. And finally, we'll have Annabelle Buzungu from ATIDI telling us about, responding or giving us her thoughts on what's been said, and also what ATIDI is doing in the market, again, to reduce the cost of capital. The Secretary of State spoke about insurance wraps and guarantees, so what's working and success stories that we can hopefully scale and replicate across the continent. So without further ado, I'd like to call upon Gabrielle Reed from Pangea Risk to make her presentation and let us know what the global macroeconomic environment is like today and some of the headwind risks. But ultimately, we're talking about how to turn risk into opportunity. So by better understanding those risks. Thank you.
Do we have sound? Yes, we do. Thank you, Omar, and thank you to ATIDI for this opportunity to speak to you all. I've been tasked with setting the scene for today's discussion and providing a high-level overview of Africa's macroeconomic landscape. Not exactly a small task to do in under 10 minutes, I think is my time. But before I start this whistle-stop tour of Africa, I wanted to begin with looking at the global... Clicking? Not yet. There we go. On the global environment, which I think is a really important starter for any discussion around Africa's outlook. Global economic prospects are weakening. We see substantial barriers to trade. We've got tighter fiscal conditions, diminishing investor confidence, and heightened policy uncertainty, which are projected to have adverse effects on global growth. In fact, the World Bank has projected global growth at 2.3% in 2025, and this is down from a 3% projection made earlier this year. Heightened geopolitical tensions, as well as commodity market volatility, have weighed on global economic prospects. And these have the potential to undermine Africa's economic outlook and exacerbate debt vulnerabilities. One of the key drivers of this uncertainty has been changes to US tariffs and trade policies. Historically, US trade policy was really rooted in multilateralism. This provided broad-based government-promoted predictable trade policies. In contrast, what we're seeing now under the America First strategy of the Trump administration is a shift, a departure from this broad-based approach, redefining international commerce by placing tariffs and bilateral negotiations at the heart of US trade policy. Now, for emerging markets, this is not necessarily a new position, but it's a pattern around changing trade relationships that have been in place for a while. But perhaps this really cements the need for trade partner diversification, as well as trade relationships are now shifting. And perhaps trade relationships once taken for granted are now less certain. Not least, the African Growth and Opportunity Act, which has long served as the foundation for US engagement with countries like Kenya, my hometown, South Africa, as well as Nigeria, granting them preferential duty-free access. Now, with the shift to bilateralism, the future of such legacy agreements is more than uncertain. So when we look at the tariff policies, I think it's fair to say that it's going to impact different countries differently. Looking at the shading of that map, which shows the proposed tariff policies from the Trump administration specific to the African continent, I think it's clear to say that there's darker shading towards the south. In Southern Africa, South Africa is the US's largest trading partner, and they face a potential 30% tariff on key exports, including automotive parts, steel, and agricultural products. This could impact South Africa's industrial competitiveness and export earnings. Lesotho, perhaps sometimes forgotten from the discussions, is facing a potential 50% tariff, which would severely impact its textile sector. Textiles represent more than 10% of GDP in the country, but more importantly, it's a sector that underpins most private sector employment. These measures have the potential to impact job losses, export revenue declines, and deeper recession pressures. East Africa, however, possibly presents a different picture. Kenya is facing the blanket 10% tariff and has no US trade deficit. In fact, in 2024, exports from Kenya to the US were above $1.5 billion, 60% of which was textiles. Now, there is an opportunity here, of course. With risk comes opportunity. Kenya could reposition itself as a possible sourcing alternative to Asia, given this factor. However, they do need to account for potential higher operating costs domestically. The DRC is also using its proposed 11% tariff as a leverage, looking to leverage its strategic critical mineral reserves as a way to gain geopolitical dynamics. Ethiopia in East Africa, though not necessarily one that's coming up particularly dark red on the map, is particularly vulnerable. In 2023, exports from Ethiopia to the US totaled upward of 500 million, but this was primarily apparel and coffee. Yes, Ethiopia is said to only face the blanket 10% tariff, but textiles and coffee in general are low-margin exports. With a trade deficit upward of 12 billion to the US and limited foreign reserves, Ethiopia is facing mounting pressure on the national bank's currency management. Falling export revenues could derail the country's fragile debt restructuring process. But I think in general there's a broader impact here, and that the US tariffs are accelerating efforts among African and other emerging market states to diversify not only trade partners, but to ensure that they reduce over-reliance on any one single market. And this has already been happening. Amid US policy unpredictability, but the longer-term global supply chain realignments, Africa is deepening its partnerships with emerging partners like China, India, the UAE, Turkey, and others. These actors are investing in logistics, energy, digital technology, and physical infrastructure, all sectors that align with Africa's development goals. We just look at trade as a single metric of this. China-Africa trade is surpassing 280 billion. This is 4 times US-Africa trade. In the map, the shading just shows where China sits higher as an export partner than the US, not necessarily that it's the main export partner in that country. But they're not the only ones playing on the continent. We're also seeing increased investment from Gulf states, who have invested over $100 billion in Africa in the past 10 years. 73 FDI projects alone, to the fee of $53 billion, were signed in 2023. Intra-Africa trade is also on the rise. We see that intra-Africa trade has surpassed $192 billion, growing 7.2% year on year in 2023 versus 2024. And this is, of course, going to be supported by the Africa Continental Free Trade Area integration. African trade is projected to grow by 5.1% both in 2025 and 2026. So what this diversification means is that Africa's economic outlook remains somewhat positive despite global headwinds. Now, specific GDP projections obviously vary slightly across the sources, but in general, Africa is consistently seen as growing as the second fastest growing region, second only to Asia. GDP growth on the continent is placed between 3.8% to 4.2% between 2025 and 2026. This growth and resilience is really underpinned by ongoing investment in infrastructure, policy reforms, and trade expansion. But more needs to be done to bridge Africa's financing gap that hinders economic development and progress, and obviously hinders progress towards the Sustainable Development Goals. Again, while this is a positive picture, there is some regional variance we need to be aware of. East Africa really leads in terms of growth, with projected growth for the region forecast to be 5.7% in 2025, with Ethiopia, Rwanda, and Uganda set to post over 6% growth in 2025, according to the IMF, and more than 7% growth in 2026. Kenya and Tanzania are, of course, also major drivers of growth in the region, not least given their infrastructure investments. West Africa presents a little bit more of a mixed picture. Here we've got a region at 4.4% in 2025. This is obviously supported by economic reforms in countries like Nigeria. We're also seeing stable growth in Cote d'Ivoire and Benin. That spike for Guinea is obviously in anticipation of bringing mining revenues online off the back of the Sindamount project. And Senegal's economy is also set to grow by 8.4% in 2025. This is really underpinned by boosted oil and LNG production. But financial gains are somewhat limited from a government perspective in the country due to limited revenue shares from these industries. And to strengthen finances, the Senegalese government is looking at potential subsidy cuts, workforce audits, as well as possible tax hikes. Of course, from a debt position, Senegal also paints quite an interesting picture off the back of the discovery of undisclosed debt of around $7 billion, pushing the 2023 debt to GDP ratio from around 74% to 99%. And of course, this did result in February downgrades for the country and will be a cornerstone of any resumed talks with the IMF on a new program. Also in West Africa, some interesting developments here that we're watching very closely is, of course, Niger, Mali, and Burkina Faso's exit from ECOWAS. And this has resulted in uncertainty in the region. The Alliance of Sahel States, or AES, has finalized its coordinated withdrawal from ECOWAS now, and this has really exposed some institutional fragmentation within the bloc and reigniting unresolved questions around financing liabilities. The new bloc, the AES, is also seeking to assert monetary sovereignty through the creation of a new central bank and is speaking around moving away from the CFA franc to have an independent currency. Of course, this is hindered by the absence of credible central bank structures at this point and constrained fiscal capacity. All the while, these countries are also facing security concerns, which I'll flag in a bit. Southern Africa, rather, is showing really modest growth. The region is due to grow by 2.6% in 2025. Zambia is really the driver of this, anticipating to benefit from rising mining revenue and improved agricultural yield. Angola somewhat subdued due to ongoing pressures around global oil prices, with South Africa really experiencing very limited economic growth. Our latest figures are there at 1% for 2025. The government figures put that at 0.8%. Central Africa is set to grow by 4.2% in 2025, with the DRC really driving much of this growth off the back of critical mineral demand. So what does that then mean from a sort of inflation and monetary policy perspective? I think it's fair to say that some African countries have really been grappling with high inflation for several years. As of 2025, there is optimism that inflation across Africa is set to reduce, with some figures placing the regional inflation from around 19% to drop down to 14%. Again, this is varied across the continent. We see South Sudan, Ethiopia, Egypt, and others really drive this anticipated inflation drop, driven by stabilization, reforms, and improved harvests. But global interest hikes, geopolitical tensions, commodity volatility, and the potential for renewed conflicts could worsen borrowing costs once more, and inflation pressures could rise, especially through food and energy prices, which of course dominate household spending across much of the continent. Central banks in sub-Saharan Africa have raised rates to stabilize currencies and control inflation, but limited policy space and some weak credibility in certain markets makes tightening more risky for growth and recovery. Finally, political instability, conflict, and terrorism, particularly in the Sahel, Sudan, and the DRC, and with rising tensions in Ethiopia, continue to threaten economic stability and regional integration. According to the Afrobarometer survey of 2024, less than 30% of Africans in the 39 countries that were surveyed believe that their governments are handling job creation or economic management effectively. Governance has stalled in several jurisdictions and has worsened in others. As one metric of this, between the year 2000 and 2002, Africa saw 123 forceful changes of executive leadership. This contributes to less predictable policy environments and heightened non-tariff trade barriers. Security concerns and governance uncertainty also raise investor risk perceptions, curbing trade opportunities and increasing borrowing costs. As it stands, African sovereigns and corporates face between 2 and 8 times higher borrowing costs than their peers in advanced economies. To conclude, Africa holds major opportunities, not least due to the global green energy transition, as well as a push to diversify supply chains. But realizing these requires reducing trade barriers, improving logistics and regulations, and investing in both physical and digital infrastructure, alongside improving governance. Sovereign lenders, financiers, and insurers, many of you in the room, play a key role in bridging Africa's financing gap by providing risk-adjusted capital and insurance solutions to unlock growth. We can hopefully better manage political, market, and operational risks. Thank you.
Thank you so much, Gabriel. So some interesting stats, and we'll share the presentation with all of you. So what we saw, obviously, in terms of trade, we saw that trade with other emerging markets, such as China, are increasing. But what's also interesting is, and we'll hear later on maybe from some of the investment banks here and some of the other DFIs here, but when we're going to raise capital, we're also going and raising capital now on other markets such as Panda bonds and Samurai bonds, and getting a much lower yield, or paying a much lower yield than what we would on the normal Eurobond market. So it'll be interesting to understand how that's working, and whether we can not just see increase in trade, but increase in institutional investors taking an interest from those markets in African paper. So without further ado, I'd like to call upon Samira Mensah, who's the Managing Director of Research and Analytics for Africa at S&P Global, to talk to us about some of the fundamentals of African risk and what we can do ultimately to better sensitize the market to understand that risk, and hopefully work for better and more prudent economic management, so that we can lower the cost of capital. Thank you.
Thank you very much, Omar. Very good morning, everyone, and all protocol observed. I really appreciated, actually, that presentation from Gabrielle. I think it really set the scene really nicely, with some numbers that we can remember, of course. And it will help, I suppose, the debate going forward. So at S&P Global Ratings, out of the 54 sovereigns in Africa, we rate about half of them, 26. And we took more than 10 positive rating actions in 2024 last year, which is more than the double that we took back in 2023. That being said, the picture is certainly mixed, and I think it reflects certainly the presentation that we've just seen, knowing that on the continent, economic trajectories are certainly diverse. And generally speaking, I think it's fair to say that we start from a low base of economic development. But some African economies actually are experiencing a robust growth trajectory, while others continue to muddle through and face hurdles when it comes to GDP growth, inclusive and sustainable economic growth, feeding, of course, directly into debt levels and high servicing cost. A few factors are indeed important, and I think the previous presentation really reflected some of these key credit factors fundamentals. The first one is, of course, macroeconomic fundamentals, which are central in shaping up sovereigns' creditworthiness. For 2025, we forecasted at the beginning of the year, actually, that the African economies will grow by 4.8%. We have revised that forecast to about 4%, which sits exactly right in the middle of Gabrielle's range, right? If you compare that to 2023 growth number, it was 4.4% back then. So it's not like a massive change. It is still upward. It is still higher than the world GDP growth number, which will average at the moment 3% in 2025. So it's good, but it's not a game-changing factor, particularly when we know what the debt levels are and what is the cost of financing and the sort of challenges that African sovereigns meet in terms of just growing their revenue base. So the African continent has experienced improved macroeconomic trajectories, though, over the past decade. At the same time, prospects have not been even across. SA's economy is set to grow at 1.3%. Senegal's economy is projected to grow at 8.5%, going back again to the previous presentation. So the stories are not the same, and the performance at the top level, so the top line, is really important because it feeds straight away into government's ability to generate revenues to then, of course, pay their current expenditures, but also invest in infrastructure and development projects, and of course, pay and service the debt. And so when we have weak growth levels, it means that debt to GDP ratios are, of course, impacted, often leading to increased borrowing costs, or increased borrowing levels, actually, to finance these infrastructure projects. Currency and exchange rate risk are certainly factors that could create a vicious circle in a context of shorter, we believe, credit and economic cycles. And I think we've seen that back in 2015 with the last, not the last actually, it wasn't the last price oil shock, but it was certainly one event that led to oil price volatility, 2020 with the pandemic, 2022 with the invasion of Russia into Ukraine, the subsequent inflation shock, and of course the tariff uncertainties with the new US administration. So certainly we have a sort of a cycle of events that tend to make economic cycles and credit cycles shorter, and also difficult to predict as far as, projection baseline is concerned. Inflationary pressures and monetary policy settings affect also real debt burdens, as central banks try and tend to raise interest rates when you have macroeconomic instability, thus affecting directly actually government domestic cost of borrowing. And so these elevated debt levels that have, of course, started at different periods for different sovereigns, when combined with wide fiscal deficits and weak revenue generation, compound credit risk factors in times of external shocks or natural catastrophe events. What's more, of course, we look at the nexus between high sovereigns and bank nexus risks, because high budget deficits tend to lead to lower credit intermediation into the private sector and crowd out the private sector from the domestic markets. Perhaps lastly, institutional and governance challenges manifest during these external shocks, and our assessments of sovereign institutions is underpinned really by policy credibility, which in turn supports sustainable growth and public finances, because ultimately our credit rating speaks to the ability and willingness, true, of sovereigns to meet their debt in full and in time. Low institutional capacity increases vulnerability to shocks and reduces investors' confidence. African sovereigns are particularly sensitive to shocks such as commodity price volatility, as I explained, global credit conditions, of course, as they tend to have a high share of their debt denominated in foreign currency. And this is because actually of their economic structures and the lack of fiscal and external buffers that could prevent or shield them during these times of external shocks. To conclude, as global debt level continue to rise, sovereign debt liability management operations that we have seen over the years will become more frequent. Since 2020, a rapid increase in government debt levels tied to successive external shocks has pushed sovereigns to undertake debt liability management exercise to address upcoming redemptions. While the majority of these events, transactions, are initiated to really be proactive in managing their debt liability duration, if you will, ahead of time and minimize refinancing risk, sorry, other may represent actually a mean to circumvent default scenarios. Debt buyback, foreign and local currency debt exchanges, debt for nature swaps, generally all aim actually to reduce refinancing risk and mitigate these risks, particularly at times of fairly high global credit conditions. So the price of US dollar funding being essentially underpinned by the Fed rates and the ECB rates. Ultimately, and perhaps to kick off the discussion, Omar, here, ultimately, I think, strengthening macroeconomic policies and debt management, improving institutional capacity, supports investor confidence and portfolio flows that feeds into the domestic capital markets. And I think South Africa is one example where we have a capital markets that is absolutely deep and liquid, thanks to a fair amount of NBFI, representing about 200% of the GDP of that country, and portfolio flows are extremely important for that country, for instance, to manage liquidity and fund the private sector. In this context, institutional investors, banks, pension funds, insurers alike, would be more willing to channel investments to the benefits of the private sector, while multilateral development banks provide financial solutions that mitigate market risk stemming from these global credit conditions that I alluded to. As financiers of infrastructure projects, MDBs and NDBs, National Development Banks as well, are essential contributors to the GEM risk database. I'm sorry. The GEM risk database is certainly something that we are looking forward to leverage on as a credit rating agency, because it helps us essentially enhance the data we use to rate private transactions, infrastructure projects, and more granularity is being brought in through the GEM database on loss given default of infrastructure projects that are financed by these MDBs and NDBs. Not everything is sort of a clear cut, but certainly the contribution of enhancing the data across our African projects will help us also contribute to better credit ratings ultimately, particularly on these infrastructure projects. Thank you very much.
Thank you, Samira. So Samira is married to someone from Benin, and I won't put you on the spot, Isabella, but maybe you'll tell us a little bit about how ATIDI did some risk profiling for Benin. And actually the gentleman next to me is also from Benin. So both of them will be interested, at least in terms of what you've done in terms of reprofiling Benin's debt. And I think Benin is actually a great example of a sound macroeconomic management and predictable policy making, clear vision, and hence why the market is keen on their paper. So maybe we'll go to Schwan next, then also from Benin, to tell us a little, but also from Lazare, so a sovereign advisor, to tell us about the market appetite for African paper, what you're seeing from the market, and also your take in terms of ways forward, and also the role of DFIs. I think Samira mentioned it, but we're increasingly seeing DFIs playing an active role in either providing some insurance wraps and also other instruments to help reduce the cost of capital. Thank you.
Thank you very much, Omar, and happy to be here. Good morning to everybody. I'm really pleased and honored to be invited to speak in front of you on this very important issue, actually, which is the cost of capital in Africa, a very critical issue for a continent which is facing massive investment needs, in particular in infrastructure. And so clearly the cost of capital is a key element for Africa to be able to finance its development at a reasonable and sustainable cost. I will try to discuss three elements. The first one is trying to identify what is the current market perception of risk in Africa and how we can understand this perception. Secondly, I will try to discuss a little bit about to what extent this perception of risk is in line with the fundamentals and the actual credit risk. And Samira mentioned it already a little bit. And the third one is if there is the idea that the cost of capital is high, regardless of whether it's in line with the actual fundamental or not, what can be done actually to reduce this cost of capital, and what type of instruments and investors can be interested in investing in Africa. So the first point regarding the market perception of the risk in Africa, first of all, I think, as also mentioned by Samira, it's important to keep in mind that I would say the fundamentals and the structural issues are key in the way investors can look at opportunities in any regions, in particular in Africa. Therefore, the economic growth, but also more structural factors like the business climate, the governance challenges, the political and security situation, as also mentioned by Gabriel, are key elements in the way investors will look at opportunities in any country, and in particular in African countries. This is why I think structurally we see that the perception is that the intrinsic risk can be high in Africa, or at least higher than in other regions. We can mention just the number of countries which are rated investment grade. We have only 2 countries on the continent in sub-Saharan Africa which are rated investment grade, when most countries that are also countries that we advise as Lazard are usually rated only single B. And a few countries which have a very strong economic dynamic and positive structural factors can be rated as BB. In particular in Western Africa, I'm thinking about Benin in particular and Ivory Coast. So we see that the structural factors are really important in the way investors perceive the risk of investing in Africa. And by definition, these are elements that are not easy to change, or at least in a short period of time. It requires some sustained effort in terms of policies. So that are the factors under which the authorities may have an influence still on the way the market perceives their risk. We also need to mention the fact that there are some elements that are beyond the control of the authorities in terms of the way the risk is perceived by investors, because as Africa is a net importer of capital flows, by definition it depends also on the global context and so the situation in other economies, in particular in advanced economies, as it was well also mentioned by Gabrielle. We have seen, for instance, that the announcement of significant increases in trade tariffs by the US on Liberation Day has shown an increase in the cost of capital in emerging markets, and in particular also in Africa, where we have seen an increase in the spreads, and therefore a cost of capital which was increasing. So it is important to recall that African countries are mainly dependent on these global financial conditions. If we look at the recent trend, we see that after the 2008 financial crisis, the low interest rate environment in developed countries has facilitated access to international market for low-income countries. And we have seen many African countries going into the bond market for the first time over these last 15 years. It was, again, due to the fact that there were less good opportunities of investment in advanced economies. And on the contrary, with the COVID crisis, some African countries lost market access during that period of time. And since then, with a higher level of interest rates globally, the access to this financing is also higher. If we just look at the most recent data, so the risk-free rate in dollars is now above 400 basis points for a 10-year maturity, which is much higher than when it was when we were in a low interest rate environment. And on top of that, we need to take into account the sovereign spreads, which are around 500 basis points, depending, of course, of the country. So it shows that in the current market conditions, having access to market below 10% is not easy for any African countries in that current context, and it does not only depend on their action, but also on the global conditions. The second point I wanted to mention is to what extent this cost of capital and this perception of risk is in line with the fundamentals and with actual credit risk. Indeed, many argue that African countries face higher cost of capital than the actual risk should lead to. Some people mentioned several reasons for that. They mentioned the Basel III prudential regulation, which is true, has some higher charges of capital for countries which are not, for instance, OECD members. Others mentioned also some methodologies of a credit rating agency. I mean, there are many reasons for which people may argue that there could be a difference between the perception of risk and the actual risk. The issue comes from mainly from the question of the data, access to data, as also mentioned by Samira, which is in the absence of comprehensive data to assess the actual risk, people need to kind of have an approximation of that risk. And for instance, in the prudential regulation, as I mentioned, the approximation is made by the fact of being, for a member, being an OECD member or not, which is by definition not necessarily fully in line with the actual risk, but it also does give an indication of what the actual risk could be, in the sense that OECD members have common rules, standards that they are committed to apply, and so we can still assume that the risk in such geographies is lower than in other countries. However, we cannot exclude at the same time that this approximation is right, I would say, on average, but not necessarily for each and any situation or each and any country. And therefore, it's important to continue to gather as much as data as possible in order to identify the actual risk in every country. This indeed requires some efforts in terms of data collection, and in this regard, the database developed by MDBs, the GEMS, is very, very useful in that regard and should be much more used by all investors as well to adjust their perception of risk. Last point I wanted to make is what can be done to reduce the cost of capital in Africa. First, I mean, we as Lazard advise our clients on also the element that I mentioned, which is fundamental, which are the structural elements. And so we advise clients on their macro fiscal strategy because it's key to ensure a sound macroeconomic framework, debt sustainability, which are prerequisite to have access to affordable cost of capital. In particular, we help our clients in their relationship with credit rating agencies. So we help them to define and elaborate their credit history, and also, more importantly, to explain perhaps more appropriately their specificities so that it can be fully taken into account and reflected in the credit rating that will be produced by rating agencies. It's really important because at the end there is always some, to a certain extent, some judgment, and it is key to have it right, to have the right assessment of creditworthiness. We also, of course, advise our clients on some specific transactions. And in that kind of transactions, we see how in their investor base, the appetite can be different from one type of investor to another, depending on the global condition, as I mentioned. In the current context, we see on the market a lot of transactions that have recourse to credit enhancement, usually provided by DFIs, that it could be bilateral institutions or multilateral institutions, like the World Bank and the African Development Bank. Again, it is key in the context where we, as I mentioned earlier, it's very difficult to have, for a plain vanilla instrument, a yield which is below 10% on a 10-year maturity. So this type of credit enhancement are very useful to help the countries to have access to financing at a lower cost, which can be sustained or more sustainable over time. The second type of transaction that we see is also, we see a lot more transactions that are executed through private placement and a bit less on, I would say, public markets. This is mainly due to the fact that private placement reduces then the risk, the execution risk, regarding the pricing, and in a context where the pricing is already very, very difficult and challenging, this reduces the risk that the cost of capital is too high. Thirdly, we can also mention some specific, I would say, pockets of liquidity that exist in that current context. Notably, we see some appetite from investors from the Gulf region, where we have much more in the current context liquidity, and there is also the willingness to develop the sukuk market. And in this regard, tapping the sukuk market in the current context, where it's much more challenging to have access to bond markets in Western Europe, for instance, can be a good way to lower the cost of capital in that current context. Lastly, I would mention the fact that even if there is I would say, a change of mood politically in the US regarding ESG considerations, there are still some appetite from investors to have opportunities that take into account these considerations. In particular, in Europe, it's clearly the case. And so some instruments, such as debt for nature swaps, blue or green bonds, this type of instrument that try to give to the investors a bit more than just, I would say, a financial investment, but also some ESG considerations, remain some useful instruments to consider for countries to have access to financing at a lower cost than the current market conditions. So to conclude, just to say three things. First, the prerequisite to have a reasonable cost of capital remains structural elements, sound macroeconomic framework, good governance, growth-friendly business climate. This should remain the priorities of countries if they want, over time, to improve their credit worthiness and to reduce the cost of capital. Second, we can't rule the fact that the cost of capital does not fully reflect the actual risk, and that in some cases the perception of risk is higher than the actual risk. And to address this issue, more transparency is needed to facilitate the assessment of the actual risk. And some initiatives in that regard are very much welcome at the GEM database. And lastly, in such a volatile environment, it is even more critical for countries to remain prudent, to be opportunistic, depending on the market conditions, and to have recourse to innovative type of instruments, which can, in that current challenging times, reduce or maximize the access of capital that they can have. Thank you very much.
Thank you, Shwan. And Annabelle, maybe you can also tell us a little bit about what ATIDI is doing with some of your clients in terms of increasing transparency and that sort of macroeconomic work that you're doing in the background to help reduce the cost of capital. So, Shwan, it was interesting that the spreads actually went up after Liberation Day. It's an interesting statistic, especially that what we've seen from your statistics is that trade with China is growing whilst trade with the US is plateauing, but those tariffs increased the spreads. When China actually announced, I think last week, that they're going tariff-free with all African countries, but obviously that didn't impact any spreads. So interesting market dynamics. And another interesting stat is actually when we look at default rates on infrastructure projects, I think Africa is sort of just after the Middle East, the best performing region at 1.9% default rates, which are very low, which I don't know what that means. Does that mean that actually we're not taking enough risk in terms of infrastructure projects, or there are not enough bankable infrastructure projects, therefore we're only investing in too few? But someone who will be able to tell us a little bit about those market dynamics, what you guys are doing is Takunda from RMB. You're very involved in a number of different capital raises on the debt capital markets. So tell us your thoughts in terms of market appetite and also innovations that you're seeing, and the role of DFIs ultimately in terms of credit enhancement and guarantees and insurance swaps, etc., that are working in the market.
Thanks, Omar. I think, firstly, thank you to the chairman, Manuel, Benjamin, and the rest of the TD team for the honor of presenting today. Really appreciate it. I think it's actually important to maybe provide a bit of context, because I think telling you what we've done and how we've set ourselves up is almost like getting to the end of the story without people actually understanding the context of what drives banks to do what they do. Specifically talking about RMB, or the First Rand Banking Group. Banks are always, we accused of being too slow, overly cautious, etc. But the reality is we operate in probably the most regulated sector globally, and rightly so. I think the basic function of a bank is, the transformation of short-term liabilities into long-term assets, or, we borrow short and from depositors, and we lend long into the economy. Now, this obviously creates a systemic risk, which regulators and Basel ask banks to make sure that, one, they've got enough liquidity, two, they've got the right capital adequacy, and three, we have got the risk frameworks internally that allow us to serve our clients, shareholders, etc. So, we're custodians of public trusts, custodians of making sure that our depositors are able to get their money out when there's liquidity. We're custodians to our shareholders to make sure that we're providing sustainable returns and sustainable dividends. We are custodians to our clients to make sure that we're providing the right solutions, custodians to our people to make sure that we're rewarding them correctly and for innovation, and also more importantly to society to make sure that we are aligned with national interests. In South Africa, a big thing has been power for us. We've been very much involved in renewable energy plants. We reached a landmark figure of $2.5 billion that we've put into renewable projects over the last 2 years, which is quite a big feat for us at FirstRand. But unfortunately, compounding all of this, and I think I've been set up sitting next to Samir here, is that we find that the sovereign ceilings that have been set by global rating agencies are quite punitive upon corporates, banks, and sometimes they're not aligned with the fundamentals. So there's almost like a rating glass floor that if we use some examples around the continent, Dangote, as big as it is, and with the reach that it has, is a B- because it's located in Nigeria. Safaricom, with as much of the impact that it is probably one of the larger banking systems on the continent, acting as a telco company, is a B because it's in Kenya. Same thing can be said by, I'll probably get fired by saying this, but Standard Bank, the largest bank on the continent by assets, is a double B because it's located in South Africa. So this makes it, these perceptions, which my colleague Schwan said, become unaligned with, the risk, the costs that we now have to charge to our clients become elevated. And I think there's quite an interesting stat from the UNDP that since COVID, the cost of debt for Africa has risen between $70 and $80 billion. That is a significant number. And that is completely game-changing. So getting to the question, sorry, that context, I really do believe context is important, but getting to the question, so as FirstRand, how do we set ourselves up? Operationally, it means that we need to invest in entities where we can attract capital. So we've got offices in the US. Not only are we trying to attract capital there, but we're also trying to get closer to the global investors, where we can market and distribute. We've got offices in London. What are we trying to do there? Trying to get closer to also a large investment pool and also the Lloyd's of London. Relationships, obviously, important to us from an insurance perspective. We've got to set up entities in Mauritius where we can book and get tax relief and make sure that we can cheapen it internally. What do? We've got teams that are focused on private equity so that we can try and invest in the real economy. We've also got venture capital set up to help with the small upcoming businesses. We have set up blended finance teams that are now focused on partnering with institutions such as ATIDI, AFDB, and Afrixim to bring right price capital to our clients. We are setting up private credit funds in our offices in Mumbai to deploy capital from there. And structurally, I think if we can use some examples, 4 or 5 years ago, our team was the first to come to market with short-term working capital solution for Ministry of Finances, where we got MEGA to wrap a trade loan to provide financing to the government of Ivory Coast. It's now quite a common product that we're seeing. When it comes to the creation of balance sheet relief. We also create SPVs where we are reliant on insurance and DFI wraps to be able to deploy cheaper capital. So I think, I'd like to probably just, touch on a point that was raised yesterday by the CEO with regards to, the importance of the ratings of, institutions such as ATIDI, AFREXIM, TDB, and AFDB, who play that very important role in helping us to relieve capital on our balance sheets, to create the structures where we can attract international capital. And I think for the comfort of those internationals that are investing, because of these covers that we've got, that, PCS and things like that do exist. So, if we look at what we've been doing in the capital markets from a local perspective, in 2022, we were the first to market to bring a gender bond for Barloworld, one of our biggest industrial companies. And after that, we followed with another bond, which is Women in Business, which was focused on SMEs, another bond. And I think from an ESG perspective, over the last 5 years, we've managed to deploy close to $5.5 billion now in just trying to support development. And quite a lot of that that we've been doing on the lending side, I think we've been heavily reliant upon, the various structures that I've mentioned. I'll leave it there and happy to take questions. Thank you.
Thank you, Takunda. So, you spoke about gender bonds, and I know that ATIDI is always very keen to make sure that we're well represented here and diverse in terms of nationalities and also gender and region. So it's fantastic. That's why they insisted that we have some talented speakers among us. None less than Annabelle, who's a senior underwriter at ATIDI, who's going to tell us a little bit about what ATIDI has done and possibly responding to what's been said in terms of improving that transparency and stronger data management. Thank you.
Thank you, Omar. It's a pleasure to be here. Well, it's actually clear that Africa needs access to capital in order to fund the USD 170 billion required annually to close the infrastructure gap, and the 90 billion that is required annually to fund the energy gap. But I mean, the question is, where's the money going to come from when we know that, the amount of concessional funding that is available out there is limited? It's actually also, reducing under Trump's administration. We've seen, the Americans shutting down development programs. We've seen them as well, cutting 555 million to the African Development Fund, the concessional arm of the AFDB. At the same time, and I appreciated, Samira, your intervention, but out of the 26 rated sovereign from S&P, only 2 are investment grade, right? Botswana and Mauritius. So it's clear that this will bring interest rates at debt levels that are oftentimes untenable. And at ATIDI, as a DFI, we are addressing this issue with our guarantees products. Manuel had mentioned earlier the Beta Water project, which we have visited with the board of directors a couple of days ago. Beta, and I'll give you this concrete example. Back in 2021, the government of Angola was looking to raise $1.1 billion to finance a water infrastructure project in the town of Beta, to restructure their water infrastructure equipments. It consists of production, storage, distribution, transmission, and also the construction of a water treatment plant. So the amounts for this project, this priority project, was quite huge at 1.1 billion. And if you recall, 2021, we're in the midst of the oil crisis, the midst of the pandemic as well, and the yields on the Angolan sovereign bonds were north of 12%. So ATIDI, together with the World Bank, the IBRD, the International Bank for Reconstruction and Development, managed to de-risk the entire commercial facility for this landmark projects. The commercial lenders, 5 in total on the project, provided 910 million in financing, and the facility was entirely de-risked by RBRD, who provided $500 million first loss guarantee, and ATIDI, together with our partners, the reinsurers, the Lloyd's market that are present here, we managed to, backstop the Angolans' government obligation vis-à-vis of the lenders. So all in all, the government was able to raise financing of $910 million at well below 7%, so that's 6.5% to be precise. So semi-concessional rates, which is actually quite, notable given the context that we were in at that time. So this is how ATIDI helps, and supports its member country to bring down the cost of capital, to bring down, the cost of capital that is needed to achieve development projects. And at the same time, some countries have also used our guarantee products in a very, I'd say, efficient ways. Countries like Benin or even Togo, who've reprofiled entirely their domestic debts with cheaper financing. So, for instance, Togo leveraged on ATIDI's, A-rated paper. So bank MUFG at the time, leveraged on ATIDI's A-rated guarantee to structure a financing for Togo and attract European and Asian investors to provide $104 million US dollars with a 12-year tenor at 4.6% interest rate. So it's important, to see how, this structure managed to bring in European and Asian investors who would have never invested in African debt had it not been for, an institution like ATIDI, who's able to provide a credit enhancement with its A-rated rating. At the same time, the second tranche was provided to Togo at that time by Société Générale. We raised $150 million on 10-year deal at 4.5%. So Togo raised in total $250 million on 10 years to prepay domestic debts, bearing interest of around 7.6%. So you can see really the delta in terms of savings. This had a huge impact, and other countries like Benin, I know Shwan and Samira, you are interested in Benin, but Benin actually replicated that same type of structure under Minister Wadani's leadership. So these are the types of innovation that we do at ATIDI. We've seen as well other innovation, in development finance from, institutions, sister companies like the World Bank, who are able to, provide debt for development swaps, debt for nature swaps, where a country exchanges basically its expensive debts for cheaper debts, and often supported by a credit enhancement like a guarantee, and then the savings are redirected into development spending. So fiscal space is actually, created as expenditures shift from servicing debt to specific development goals. So these types of structure were done, I know, in certain countries like Ecuador, but also on the continent, in Gabon, in Côte d'Ivoire, in the Seychelles. So this is the types of innovation that we see in the development finance, where ATIDI is actually playing a very instrumental role, and will keep continuing playing this role for as long as financial architecture is misaligned with the requirements that African countries have in terms of raising capital at affordable and sustainable terms. So to answer your question, Omar, in terms of the transparency, what we've done as well in this space, because Shwan had mentioned that it's important as well for sovereigns, African sovereigns, to be transparent in order to change the perception of risk. At ATIDI, we've played as well an important role in that space. We often say that, at times it's not so much the real risk, but investors are wary, have a perception of risk that is, higher on the continent. So we encourage our sovereigns, we encourage our member countries to be transparent. And we've developed actually in the energy space what we call the transparency tools, where we've asked, the utility companies on the continent to be transparent about, their payment, the repayment of their obligations. Providing information, something akin to Dun & Bradstreet, like a sort of a payment index that showcase, that demonstrate to IPPs that utility companies do eventually pay, albeit sometimes with a delay, but eventually they will pay, right? And to my knowledge, no African countries have ever defaulted on an energy project. So this is the work that we do with, with utility companies, so as the SOEs, and that can be actually, say, extended to other sectors as well. So I'll pause there and take any questions if anyone has any. Thank you.
Thank you, Annabelle. So we've actually run out of time, but maybe we can have, let's say, 3 comments from the floor, if you wish, and then we'll go into the next panel, and then we can take more comments across the 2 panels. So if you can just press the button, let us know who you are, and any comment. If it's a question, please let us know who is it addressed to.
Oui, merci. Mon nom c'est Mouyemba Niab.
My name is Muyemba Diap, and I'm representing the government of Togo. I have a question regarding risk perception. Well, I have well noted that the bias may come from the transparency deficit or the lack of communication. So that is a message that we hear well. But the banker mentioned, some punitive ratings because, you have, Madam Samira, I think, expressed it. I have under my nose here a report from the UNDP that indicates that what we are talking about here is not really small. And that report states that Africa is losing every year around $75 billion US every year. It has been said that the infrastructure deficit is around 100, I think, or 70. So if we recover the bias related to perception, I think we can move forward. So from 74 billion, 5 billion from billion. So Africa is losing out around 75 or 74 billion every year. So the Moody's agents, is indicating that the default rate regarding infrastructure financing shows that Africa is well classified if you compare to Asia and Latin America. So the default rate, that is actually a report from 5 years ago. Maybe things have increased, but from 2020, the default rate was 5.5%, and it is 8.5% for Asia and 13% for Latin America. Despite that best position of Africa, Africa is suffering from a poor perception, a negative perception. compared to Asia and Latin America. I'm happy to see your prospects regarding all that. Thank you.
Simmer, you'd like to take that?
Yes, I'm happy to start because I'm sure many will contribute. Thank you very much for your question. I'll respond in English. I think it will be just easier for me, even though I'm French. It's an important issue that you have raised, very serious, because if we want to consider the long-term development on the continent, yes, the cost of financing has to come down. It's equally important to certainly highlight the fact that credit ratings are one component in the decision-makings of capital allocators. Capital allocators, so global investors, decide on ultimately what is their trade-off when it comes to the returns they want to get on a loan or a bond they buy. So it's like an ecosystem, if you will. As long as, I suppose, African sovereigns will raise funding on the global market in foreign currency, so in US dollars, there's a number of factors to take into consideration, and global credit conditions, so the price of US dollar liquidity is important. Just as an example, in 2021, Kenya raised $2 billion at 6.3% or 6.4%. So that was a Eurobond. That was 2021. Pricing of US dollar liquidity was such that actually rates were still low. So that was just before essentially what happened, the external event that happened in February 2022. When Kenya tried to refinance the maiden name 2014 Eurobond, 2 billion as well, so that was due in June 2024, they raised 1.5 billion at 11.6%, I think, or close to. Please don't hold me to it, but let's call it a 12%. In last year, essentially, a year ago or so, the price of global liquidity, so US dollar liquidity, was way more expensive because of where the US Fed's rates were. So it's that, so that's one thing, and I think we all have mentioned this, and also the perception. So the perception of risk for global investors, not for rating agencies. We don't trade and we don't rate on perception of risk. We have very defined and clear methodology where we compare African risk with LATAM risk, with Asian risk, with European risk. So an investment grade rating, as far as we are concerned for Botswana, for instance, it's not a lower BBB plus rating comparatively to another BBB plus country. It is exactly the same when it comes to the definition of what we rate to, which is the ability and willingness to pay financial obligations in time and in full. So there is no haircut in that. But that perception of risk that I want to go back to was for investors the notion that essentially that proactive debt liability or liability management was not proactive enough for them, and essentially they decided, given where the US dollar liquidity pricing is and their sense that refinancing was not handled early enough, ended up with that 12%, and I hope it's 12%, but I think it's close to anyway. It was close to that. So it's not just the credit ratings. I really want to emphasize that. Yes, it is one component. It's an important component. So global credit ratings are important to attract global liquidity because that's where the capital is. And I know that Annabelle said earlier, where are we going to find these trillions of dollars that we need to develop our infrastructure pipelines. For now, the liquidity is certainly, the trillions are in the US and Europe. There is idle capital sitting there, and yes, you know, the global allocators will find a way to price it the way they deem fit. We equally know that the global financial crisis back in 2008 has taught us that essentially no one operates in a vacuum, but also regulation has imposed on all these global investors to essentially also run their own credit research. So yes, they use credit ratings, but they also have their own credit research. It's important for them to essentially sort of mix the two and decide on where they want to go from there. So I think it's important to be balanced when it comes to that. Are global credit rating agency answering the full equation when it comes to credit risk? Perhaps national ratings could be more appropriate for domestic liquidity, but we have seen that like volatile or let's say volatile macroeconomic indicators in many countries in Africa led to essentially high inflation, and so central banks have raised the cost of borrowing as well domestically. It's not just, you know, global investors and global liquidity pricing. Even global, even domestic pricing have been very high because macroeconomic instability were underpinning the rationale for central banks. You know, African central banks raised the interest rates. So I think we have to be balanced in the way we look at things. It is true what you are saying, but there are reasons for them, and I think it's fair to essentially talk about all of it, not just part of it.
Thank you, Samira. Takunda had to get a flight, so he's rushed out, but he mentioned something that probably doesn't get enough attention, which is Basel III and the constraints that it places on a lot of African financials. So Basel III is something that, the credit ratings debate is live and very much alive, and with lots of opinions out there, but the Basel III debate is probably not considered enough, and maybe a lot more advocacy and lobbying needs to be done around that to also see how we can create sort of, I don't want to say looser regulation, but different regulations that does not penalize African capital, which Takunda mentioned earlier. So we're actually running a little bit late, but we'll take one more, and then we'll have to go to a quick coffee break before coming back for the roundtable.
Mr. Moderator, thank you for the opportunity. I just wanted to make a clarification. My name is Albert Mwenda. I come from Kenya, and because there might be some investors here, I wanted to just clarify that Kenya has not to date issued a bond at rates above 2 digits. They are all below 2 digits. The 2024 bond that was issued to refinance some expensive debt was issued at 9.7%. And even the one that was issued sometime this year was also at below 2 digits. Just wanted to be on record. Thank you, Chair.
Okay, so this gentleman here is lucky, so because that wasn't a statement, a clarification, so go ahead. If you can be very quick, please. Thank you.
Okay.
My name is Mongo Philippe from Burkina Faso. So right now I want first of all to thank you for the clarity of these presentations that were given, and I want to congratulate the efforts that ATIDI has been making in these different countries. So I would like to take this opportunity to ask a question regarding the first presentation of the lady that really touched me. Thank you very much, madam. So this question is regarding the efforts. What are the efforts that are being made by different banks and the investors just to support the efforts of the states, the states of the Sahel? I'm talking about these 3 countries that right now are under this issue of terrorism. What are the efforts that the investors are making in this regard? Because we see that in these days, these investors, like the presenter said, they have some restrictions of financing regarding them. Thank you very much.
Thank you very much for the question. I think what we're seeing is that in the region, specifically the 3 states that I mentioned, Niger, Mali, and Burkina Faso, we're seeing a repositioning. We're seeing a repositioning of diplomatic relations regionally, and that is, probably most clearly indicated by the exit from ECOWAS. We're seeing a repositioning globally in terms of diplomatic relations, shifting perhaps from French relations to further east, including Russia and China. I would say that we're still in the midst of this repositioning. And because of that, efforts to address insecurity, as well as then the sort of secondary conversations when it comes to financing, are almost in a pause. This repositioning has to settle, the dust has to settle first before the picture is a little bit clearer. At that point, how governments, whether it's with partners or not, are able to address the security concerns will become clearer. And I think with that will bring what all investors are often looking for: greater predictability, greater certainty, though it will never be 100%. And with that, I think bankers will come into the conversation. So unfortunately, we're still in a position of shifting sands, and until that settles, I think there'll be a delay before we see the progress. I hope that answers your question.
Thank you very much to all the discussants today. Thank you all for being here. I think well, the message that I take home is that we're all on the same side, and that we need to work together ultimately, because it makes sense for all of us that African paper and African capital becomes interesting, or interesting. It is interesting, but it becomes attractive to the wider world. I think the role of the DFIs has been highlighted by Annabelle and by all of us today, and I think the next session will probably emphasize that. And I think the messaging that I've heard from the past couple of days is that we need to be supportive of the DFIs, because they're going to be playing a very critical role over the next few years, or especially with all the turbulence that we're seeing and the changes that we're seeing in terms of ODA and international interest on the continent. And maybe in the next panel, in the next roundtable, we'll also hear about opportunities elsewhere. So what some of these DFIs are doing to attract capital, as I said, from China and Japan. And I think the team from AFC and Bank of Industry may give us some clear examples there. So a round of applause. We've got a very quick comfort break, and then we'll come back in 5 minutes. So there's some coffee outside, but if we can be back in the next 5 to 10 minutes maximum. Thank you, please. And if our next speakers can come and sit around here, we'll seat them and the next moderator.
Hello everyone, welcome back. Rebonjour à tous. J'espère que vous avez apprécié la pause.
I think you appreciated this time for a break.
Roundtable. Let's build on that. Let's move swiftly to the second roundtable, reducing the cost of capital through innovation. And we'll be together exploring concrete actionable strategies from blended finance to capital markets reform, from guarantees to liquidity mechanisms, to not only unlock capital, but ensure that it works harder and smarter. And I really want to stress these points. So we were hoping to start with an insight from Dr. Vera Songwe. She was going to join us online. We're having a couple of technical issues, but we do hope that she'll be able to join at some point. So now, let me introduce our discussions. So we'll start with welcoming Mr. Delvin Pipa, Director of Studies and Market Development at Capital Market Commission here in Angola. We also have in the center table Mr. John Martin Dawula, Vice President for Financial Institutions and Trade Finance at the African Finance Corporation in Nigeria. We are also in the company of Mr. Leonard Kange, Special Advisor to the Managing Director and CEO of Bank of Industry in Nigeria also. We also have a lady, as you can see, Mrs. Claudia Lopes. She's Head of Trade, Syndications and Distribution for Financial Markets and Banking at Crown Agents Bank. And last but certainly not least, we have Dr. Patrick Olomo, Acting Director for Economic Development, Integration and Trade, Head of Economic Policy and Sustainable Development at the African Union Commission. And I would actually like to start with you, Dr. Olomo, because you will have to leave us in a few minutes to join a meeting. So I would like to start by asking you, we have been hearing how different institutions and innovation are taking place at ground level. However, while there is consensus at a continental level, we do see that fragmentations persist at a national level. So can you please tell us how can the African Union better support financial institutions and sovereigns to ensure regulatory consistency and policy alignment? And also, what role can the AU play in championing risk mitigation and strengthening capital access across the continent?
Thank you. Thank you very much, Madam Chair. And as this is my first time to take the floor, I would like, on behalf of the African Union, to sincerely appreciate the organizers and the host of the meeting, ATIDI, for the excellent organization of the meeting since we arrived here in Luanda. Allow me also, on behalf of the AU, to sincerely appreciate Angola for hosting this event and for providing all the facilities that we are enjoying since we arrived here in Luanda. It is the Africa we all want. That's the Africa we are all looking for. With regards to the question that you asked, Madam Chair, I would like to first of all set the scene for our conversation today. And one of the most pressing challenges that our economies are facing today is relating to the high cost of capital. And this, we can see it in many forms. The first one is the fact that our capacities to access concessional financing today, as was highlighted in the first session, is certainly to be questioned, because despite the fact that there are actions that are undertaken at the continental level and at the global level to reduce the cost of capital for African countries, we can actually see that the cost of capital is still getting higher and higher. And this is absolutely difficult for our countries to mobilize resources in a sustainable manner and finance development effectively, as we are all looking for. The second point that I would like to draw your attention on is about the high debt cost. That is also depriving our continent of absolutely important resources. And if you can look at the data, you will see that our countries are, financing debt at an extremely high cost, which is estimated today by the African Development Bank at more than 500% what is required for the multilateral development system that is in place. It means that we are paying 500% above what is required and acceptable. It shows that there is certainly, an important, decision to make, or that there are reforms that need to be conducted at the global level to make sure that African countries have, access to capital at an affordable and, cost that is allowing them to invest in development. The third point is about the credit rating system that is also affecting the way our countries are accessing capital. And for that, I think in the first session, we had a figure of approximately $74 billion that we are losing per year because of, poor risk perception. But in addition to all those resources that we are losing, it is also important to draw your attention on what we are losing in terms of illicit financial flows, estimated at approximately $90 billion, corruption at approximately $148 billion, and international profit shifting is costing also $275 billion per year. The aggregate figure that we have is that the continent is losing $587 billion per year, which, if we take it on a daily basis, means that we are losing not less than 570 million per day. So, when we see this context, we can now understand the role of the African Union as permanent member of the G20, but also as continental institution that has the mandate of representing the continent in global discussions. First of all, when we look at our interventions at the G20, the first point that we raised with the support of the South African presidency was with regards to the fact that we wanted to, bring the attention or draw the attention of G20 members on the cost of capital, which is extremely high. And that conversation, I think, will allow us this year, with the support of institutions such as ATIDI, the African Development Bank, Afrexim Bank, to provide continental tailor-made responses to those to that very important issue. Secondly, our call has always been to support our multilateral development banks. And in 2023, precisely in February, we have set up at the African Union level what we call the Alliance of African Multilateral Financial Institutions, which demonstrates that, once again, the African Union is playing the vital role that it should play to protect our continental financial institutions against all odds. I don't want to allude to the international context that you all are familiar with. You know the geopolitical tensions, you know the geo-economical tensions, the trade wars and all the issues that we are grappling with. But fundamentally, our call has been that our financial institutions, including ATIDI, should enjoy the high-level protection that should come from our member states. And in that perspective, if you look at the set of decisions that have recently been adopted by ministers of finance in 2023, you will see that there is a constant call for the respect of the preferred creditor status of African multilateral financial institutions. This is enshrined in their treaties that all our member states have signed and ratified. So there is no need for us to question, the protection that should be provided to our financial institutions against all the dangers and all the odds that we are facing. That is number one, Madam Chair. Secondly, the global context, as I said, is having a huge impact on the way African multilateral financial institutions are being considered, even in global discussions. None of our institutions to date is part of the global deal of the common framework for debt treatment. This, in our perspective, and that is the call that we have formulated at the G20, is certainly an important strategic mistake, because our financial institutions are the only institutions that understand the seriousness and the magnitude of the challenge that our countries are facing. And they are the ones providing the last resort support to our member states when they are facing challenges. So their protection is, for us at the African Union, the number one priority that we are pushing to, to agree on at continental, but also at international level. Unfortunately, maybe as your question, and I want to be clear on that, there is no situation that they are not supporting our financial institutions. Not to conclude and say that let's not just, take the things in the side of perceptions. We need to have facts, we need to know the reality, and we need to know that there is no other commitments than the one that is aimed at supporting our multilateral financial institutions. We are going to hold series of consultations, prior to the Continental Ministerial Meeting of Finance, Monetary Affairs, Economic Planning and Integration that is scheduled to be held from 29 September to 3 of August 2025, where we will insist once again on the need to protect our financial institutions. They are our institutions. They know how to support the continent. They have been doing that with pride, with the resources that they have at an extremely affordable cost, and we do really absolutely believe that they need to be protected and they need to be secured against all the dangers. Thank you very much.
Thank you very much, Dr. Lomo, for such a compelling reminder, first of all, of the key role that the African Union plays, and also for all these incredible numbers that you just shared. I know we know that, the gaps are huge, but we are also, we need to bear in mind that these are trickling down to every single citizen on day. Less infrastructures, less school, less hospital, less food on the table. So indeed, these discussions are very, very important. Thank you very much, Dr. Lomo. I'm very aware that you might have to leave us at any moment. But let's now turn to you, Mr. Pipa, and zoom in on your country, our host, Angola. What key developments are you seeing in Angola to boost market liquidity, particularly around privatizations and domestic capital mobilization? And how can these efforts help build stronger long-term investor confidence?
Thanks. I will be addressing in Portuguese. Bom dia.
Good morning to all the members of the board from ATIDI and all the invitees. Well, in Angola, we have a capital market which is still dominated by the public debt. And it's very important for us to share this point and say that the market has been developing with new instruments. This is since 2022 up to today. We've been having a very active market of our assets, and from then up to today we have four companies that have introduced their shares into the market, and from this they managed to finance in the capital market. And from these three companies we have two that are active. Well, this is a young market, and have been feeling a very good growth, and I believe this market will be able to get a good position. Well, we understand that what we have to do to be able to turn our market more attractive and also reduce the cost of capital, this has to be done by supporting the financial system, and also to be able to have other sectors besides the banking systems, so that the whole space can be able to win and be able to support our market and finance the economy. And with this, these emissions of shares, they will be taken seriously through privatization programs that the government launched. And through these programs, most of assets which are part of the government were also sent to the private sector through tenders, and some of these are defined to be able to be privatized through the public offerings. And this strategy of the government activated the capital market through a certain segment, which is the market of shares, and this has been used to support these activities and other entities to be able to use the capital market as an alternative. There are also many other entities which we've identified to be able to also buy these shares. We're talking about three companies, and we have noticed that besides the government itself that chooses to sell some of their shares to privatizations, has also shared their initiatives to the private sectors, and also called different companies which have been financing in the market. And I think these initiatives are welcome, and they will help us to be able to make our market to grow, and it's going to bring more independence in our finance system, whereby for us to be able to have a better idea, we can say we have a type of support which has helped us to negotiate about 6 billion kwanzas. And from this amount of the negotiation, the biggest part is still dominated for the negotiations of public debts, and also but also through introducing more instruments, we'll be able to have different alternatives, which is going to bring some kind of competitions, and it's going to support us to reduce the cost of capital. Well, we've been doing and we've been searching for ways to break some existing cultures, which is to fear to open the capital. We are scared to lose control, and this makes some companies to resist due to do a certain finance to the market of capital. So we've tried to create some initiatives with the agents in the markets, whereby we try to approach some new companies and some investors to be able to see how we can transmit our potential and the opportunities which exist in the investment as a way of alternative finance which are existing in the capital market. So we've been trying to do this, which is to approach these investors and also to try to transmit that this financial market that we have different assets on it, and these ideas are welcome, which is going to bring a lot of resilience to our entity. We also have some entities and investors which at this moment show some fear to be able to diversify their wallets, and we've had some institutional investors who have invested more than 85% in their titles of public debts, whereby when we look at other countries, other places, we see these investors to be able to participating more in the market of shares, assets, and also private equity. We are aware of the very long journey that we have, and the participation of the multilateral institutions and collaborations with other institutions, it's key for us to be able to bring the freedom that we need, and for us to be able to believe in the internal strength that we have to be able to support our market and also support the national institutions. Thank you very much.
Pipa, para esta apresentação. Independência, robustez, palavras-chave não são. Muito obrigada. And it's very true that we'll have to proceed to...
And it's very true that we have to follow on this journey of breaking this culture of fear.
You, Mr. John Martin Dawula, your institution, AFC, plays a key role in supporting sovereigns, sub-sovereigns, and corporates alike. How is AFC leveraging its credit ratings and innovations to help reduce the perception of African risk? Could you also touch, please, on any recent innovations in this place?
Thank you very much. It's a pleasure to be here. I thank ATIDI, which is a sister African multilateral to Africa Finance Corporation, for inviting me and for inviting AFC. So you've probably heard about AFC. AFC is a multilateral that was set up to promote economic development in Africa by investing in projects, especially, that are geared towards solving key problems that are hindrances to economic development in Africa. So just to touch on that side, for instance, the connectedness of Africa. It has been said that Africa is a market of 1 billion plus people, but that market is highly fragmented. So in relation to the connectedness, AFC invests in physical and also digital infrastructure assets in order to ensure that there is actually linkages to make that market a reality. AFC also invests in energy resources across the continent to ensure that Africa can actually harness its energy potential. And then there is the question of industry. We'll all agree that Africa is rich, highly rich in raw materials, but the economic development that we seek to achieve is not going to be attained if countries continue to export raw materials. So one of the things that AFC does is to try and promote the building of industry in Africa, with the objective of that being beneficiation to add value to raw materials and therefore to promote the value that countries extract from their raw material resources. So away from those challenges, because that is really now the infrastructure side of AFC, but AFC is also interested in access to finance, which is the topic for today, reducing the cost of capital through innovation. So I guess one of the things that AFC does from that angle is that, since our inception in 2007, we have built a track record of structuring transactions in various sectors, some of which I have mentioned. We've structured transactions in the project finance space, in the sovereign space for FIs, banks, but also in the corporate finance space. So we've built a strong track record, we've built experience to ensure that the opportunities that exist within the continent, which are most times at a very raw stage, right? We'll all agree that opportunities are not in shortage on the African continent. But the question is, how bankable are those opportunities? So AFC has built the experience to bring those raw opportunities to bankability through our structuring knowledge. And then after that, we pride ourselves in playing a catalytic role to ensure that capital, especially global capital, flows into these projects across the African continent, and it flows affordably. So that's one of the things that AFC does. And then the second thing is obviously funding. We ourselves participate in these transactions across the sectors that I mentioned. We are funded in hard currency. We know that Africa is still a net importer from the rest of the world. We need hard currency for critical imports, for instance, like refined petroleum, like we saw during COVID, for medicines, etc. So AFC, alongside our global partners, we bring in capital to meet the financing requirements of African players. I've been asked a question on de-risking, which is essentially AFC's role to ensure that capital is affordable. In the first session of the roundtable, one of the speakers mentioned that, for instance, banks are capped at the ratings of their sovereigns. So you find large banks, for instance, in South Africa being capped at the rating of the South African sovereign, large banks in Egypt being capped at the rating of the Egyptian sovereign, and we see that in Nigeria and other countries. By virtue of the way that multilaterals like AFC are instituted or incorporated, we have ratings that are able to supersede the ratings of countries in Africa. For instance, AFC is rated A3, just like ATIDI, and that A3 is essentially investment grade rating. So we use that rating to wrap transactions in the sectors which I mentioned earlier. We wrap transactions, for instance, in trade. We offer our guarantees to ensure that banks across the continent have confirmation lines that they can use to satisfy their import trade requirements. We use our A rating to wrap sovereign debt issuances. A good example that comes to mind is the Samurai bond that was issued by the Arab Republic of Egypt about a year and a half ago with the help of a Japanese bank. So the European subsidiary of the Japanese bank obviously was subject to European regulatory requirements, which is also another hindrance for banks, by the way. So the European subsidiary came to AFC and asked us to re-guarantee them so that they could wrap the debt issuance by the Republic of Egypt. When Egypt issued this samurai bond, the bond was actually oversubscribed in the Japanese market where the bond was sold. So AFC's participation in that transaction played a key role in ensuring that the country affordably accessed financing. At the time, you'll recall, late 2023, risk fundamentals were still very much high across emerging markets, and it was very expensive for countries to tap into financing. But that bond was actually very successful. AFC also wraps banks that are looking to raise capital from third parties. I'm joined on this panel by our friend, Mr. Leonard Kangi from Bank of Industry. AFC contributed successfully to Bank of Industry raising up to €2 billion last year from the international capital markets, again by throwing our weight behind the Bank of Industry. At that time, Nigeria was rated CAA1. AFC threw our A rating behind the Bank of Industry, enabling them to diversify their lender pool and also to optimize their cost of funding in that transaction. From an access to finance angle, we're also very much interested in the development of local capital markets. So I've spoken about the foreign currency side of things, but local currency, the different African countries, for instance, have capital markets that are denominated in various local currencies. So in this regard, what AFC has done is that we've partnered with key partners. For instance, in Nigeria, we partnered with the Nigeria Sovereign Investment Authority to set up an institution called InfraCredit. InfraCredit basically offers local currency debt wraps to local currency debt issuances. What that does is that it enables local investors, especially pension funds, because we all appreciate that pension funds have liabilities that are long-term that can be deployed to projects that require long-term capital. So we've done that in Nigeria. We're looking to replicate that in Kenya with a company called Damana, and also across various other countries in Africa, basically helping to deepen the participation of local capital markets with regards to raising of capital for local development. Coming back to AFC, we're also looking to diversify our own funding. We have recently procured a rating from China, from S&P China, which is a AAA rating in China. And what that means is that AFC is now ready to raise funding from the Chinese market. I'm sure anytime from now you'll be hearing of us raising new capital within those markets like Asia, which capital we hope to come back and deploy affordably on the African continent. We are also constantly trying to increase or to widen our shareholder base. A year or so ago, we invited our first non-regional member, being the Republic of Turkey, investing capital in AFC's, investing in AFC's capital, also looking to continue to promote our activities across the African continent. I think the previous speaker, Dr. Lomo, mentioned what we are doing as African multilaterals from a perspective of advocacy. I'm not going to repeat his comments on the conversation that are going on around preferred creditor status, but that's also one of the areas that AFC is very much involved in. Our president, Mr. Samaila Zubairu, is currently the president of the Alliance of African Multilateral Financial Institutions. And we're trying to speak with a single voice, just trying to highlight the role, the counter-cyclical role that African multilaterals have played across the continent, especially in the last 4 years, when we acted as lenders of last resort, when we continued to provide financing into sectors that others seem to have shied away from, for instance, like oil and gas, which are the mainstays of economies of different African countries. For instance, like Nigeria, if you say Nigeria cannot exploit its oil and gas resources, then you're definitely hindering the economic progress of that country. So I'll stop here, and I'll be happy to take questions.
Thank you very much, and we are looking forward to your questions indeed. So thank you very much, Mr. Ndawoula, for this insightful overview of the crucial actions taken by AFC. And that brings me to you, Mr. Kange. We've heard the impactful role of AFC, and let's talk about collaboration. How is the Bank of Industry working with institutions like AFC to mobilize and deploy capital, particularly into local industries, and what blended finance tools are proving most useful in Nigeria's context to stimulate industrial growth and job creation?
Thank you very much, Anne-Marie. And thanks to the ATIDI team led by Mr. Moses for giving us this opportunity and the great work you're doing supporting African development with risk mitigation that makes it possible for us to survive despite all the headwinds that we're facing macroeconomically. The Bank of Industry is a national DFI. We're owned by the federal government of Nigeria. So we're publicly owned, 65 years old, but our focus is strictly on the private sector. And what we do is to focus on supporting industry, basically to help industry to add value. One of the challenges that most African nations are facing is the issue of, shipping out raw materials, unprocessed, no value addition, it's taken out of the continent, then refined and processed into finished goods, and sold back to the continent at multiples of what we received. It is not a surprise that most African countries are having significant challenges, deficits, budget challenges, revenue challenges, and the economy is not growing, unemployment is very high, not much is happening in terms of growth. This has to change, and that is the mission that Bank of Industry has been entrusted with in Nigeria, to support our MSMEs, to produce, to grow, to add value, and stop this vicious cycle of commodity, sending out commodities, etc., and all of that. Every time you hear the markets have changed, the prices have changed of commodities, what happens? The revenue expected for most governments goes down. And that's why we're facing all these challenges. So to address that, it's one of our key missions. Now, Mr. Olomo and a number of people, I think Annabelle also mentioned about the huge gap, funding gap, that Africa is facing. Now, the figure ranges from 100 billion annually to more, depending on who you speak to. How do you address this? Because for industry to grow, for us to create wealth and produce, we need to produce at a competitive rate, which means that the cost of financing must come down. It is not sustainable where it is now. We must bring that cost of financing down. And how do we do that? You've seen the rating actions that happens since COVID. Only 2 African countries have investment grade rating. So, if a DFI like BOI approaches the market, we'll be talking about raising money benchmarked against the sovereign. Nigeria debt is about 12%, sometimes more, depending, right? So if we are a national DFI, we're talking about that percentage plus a premium because we're a DFI. You deploy that kind of money to support an MSME trying to produce at what tenor? Maybe 2 years, 3 years, because it's very also limited in that aspect. And you're talking about a project, a manufacturing project, which requires patient capital, long-term funding at affordable rates. That project is dead on arrival. So we have this vicious cycle, right? We need money, we can't get it at affordable rates, our industries are suffering, we have unemployment, economies are going down, etc., and that makes it even more difficult for the countries to be rated investment grade because, so how do we get out of it? What that means is that we need to innovate. We have to find creative ways of raising money at affordable rates and in the volume and amounts that are required for us to make a difference. And that is what the Bank of Industry has done. With the help of our very good friends like the AFC, they've provided support to us. I will just use one example of the most recent transaction that we concluded last year. Bank of Industry, with the support of the AFC, was able to raise 2 billion euro from the international market at a pricing of Euribor plus 1.2%. How's that possible? Nigeria is rated CAAA, CAA1. That's not investment grade. So what happened here is that with the rating, the AR rating of AFC and the guarantee that they were able to provide, Bank of Industry was then viewed based on that rating. And so that enabled us to raise that funding. A number of things happened to make this possible because this was the largest transaction by any national DFI on the continent. The pricing was very significantly lower than the double digits that you would expect. We had to also do some innovation in terms of the structuring. Now, one of the things that we did, for instance, is that we looked at dual currencies. So the offer was placed into the market based on euro as well as dollar. Now, we all know that the pricing between euro and dollar, there's a difference of at least 200 basis points. That is significant. So by using dual currencies, we were able to, blend and bring the cost down. The second aspect of it was to be able to attract various pools of liquidities from the world. We layered the guarantee in the sense that we had two versions there, because before we approached the market, we did a non-deal roadshow. Went to Europe, went to America, went to the Gulf countries, went to Asia. And what we're hearing is that there were some liquidity, some regions that said, we prefer 100% guarantee. We don't want to take risk. Some others said, we don't mind a partial guarantee, so we'll be willing to take some Nigeria risk. So we had two tranches. Tranche 1, 100% guarantee. Tranche 2, 85% guarantee and 15% Nigeria risk, and priced accordingly. Now, what that did was that we were able to now attract different pools of liquidity based on their preferences. And this is one of the reasons that we were able to get the transaction up to that level of 2 billion. So that is on the upstream side. Now, having raised that money, you now have to deploy it into the market. In the market, you have MSMEs, you have youths, you have women-owned businesses, etc. There are challenges accessing the funds. Even though the pricing is affordable, there are issues of collateral, there are issues of so many other issues that actually become a challenge. And that is where, again, ATIDI and other credit insurance companies came in. We were able to secure support to guarantee, for portfolio guarantees, for risk insurance, etc., credit insurance and all of that, first loss, etc., to guarantee the lending that we were making to the MSMEs, women-owned businesses, and the youths. And with that, we were then able to scale the deployment of these funds. You know, ATIDI also helped in terms of supporting the subscribers to our offer by providing credit risk insurance, and that enabled them to have more capacity to take up the offer that we put forward. So we're really, really very, very happy with ATIDI and with all our various partners for all the work that they do. And what we would like to do, what we would like for the African countries and others to consider is we all have foreign reserves and all of that. We all have various funds in different pools. Why do we leave it in foreign countries trying to raise our reserves? Why don't we bring that money in to support the likes of ATIDI, AFC, etc., so that we can deploy this money on a sustainable basis? That's one of the thoughts that we would like to leave with you. The other thing is that, yes, African governments are challenged, but there are ways, innovative ways. For instance, we are owned by the federal government of Nigeria. The federal government, if you tell the federal government of Nigeria today to write you a check for 2 billion, it will be a struggle, given other priorities that they have. But they are able to provide a guarantee to a state-owned enterprise like BOI in order to access these pools of funding and to deploy it in a way that helps to grow the economy and make the changes that are required. So I will stop here for now. Happy to take questions. Thank you.
Thank you very much, Mr. Kange. A lot of food for thought there. And just very quickly, going back to this issue of export of raw materials, I was reminded of this quote by the African World Bank's Adeshina, who said, "The export of raw materials is a door to poverty." I think that says it all. Thank you so much for mentioning, and I know that Mr. Ndawula also touched on that. So now, very briefly, because we've got about 10 minutes left, I'd like to leave the floor to you now, Mrs. Lopez, to take a market-wide view even further. From your position in international markets, what recent developments are you seeing that are helping to support African sovereigns and financial institutions? How do tools like insurance and guarantees, especially those provided by institutions like ATIDI, enhance investor confidence and enable capital mobilization?
Thank you very much. Thank you all. It's a pleasure to be here. Thank you, ATIDI, for inviting us to be here. So I will try not to repeat myself because of a lot of the previous panelists have touched on a lot of the subjects that I will be discussing as well. But I think I'll try to bring to you a different approach, so to speak, because at Crown Agents Bank, we're very, very committed to the region. We have very deep relationships with the financial institutions, private sector, and also the central banks in the region. So we are very proud to be here and committed, and we believe we have a lot of knowledge there, especially on the FX side and on the trade side. So I wanted to bring a little bit the discussion about the trade side, because we're all talking about long-term financing, we're talking about infrastructure projects, so I don't want to repeat myself and bring those discussions back, because I think you all have already touched on these very in depth. So in terms of, and of course I will bring my view as a bank, because we are a bank, as my previous panelists also mentioned, Takunda. We are very regulated, whether we sit in SA, whether we sit in London, which is my case. We are extremely regulated, and when we lend to emerging market countries, we are penalized by that, of course. So there's a lot of, and this is completely outside of our control, because these are regulatory requirements. So when we think about sovereigns, I think you guys have already touched on the sort of blended finance structures, how deep they can, how useful they can be in terms of improving pricing for the borrowers and crowdfunding with different sectors. So they can crowdfund with the commercial banks, they can bring the MDBs and DFI supports, and you have also touched that what we have now is not exactly even throughout the region, and it's not enough. We get that. But of course, having that option helps a lot the banks to be able to scale their appetite, so to speak. The other thing I think in terms of developments that is very important, and I think I include ATIDI there and the whole of the private insurance market, the credit insurance market, is the appetite for sovereign risk with credit enhancement. So that allows, of course, banks to underwrite more, distribute more, syndicate more. The other sort of recent development, I mean not recent as in 24, recent in terms of the last few years, you have guarantee programs. You have the guarantees from the likes of MIGA, but you also have on the private sector from the DFIs, helping the banks on the short-term space. So I want to focus a little bit more on the short-term space, because I think, as I mentioned to you before, you have touched upon the long-term as well. So thinking about the short-term space, we see a lot of focus on how important short-term trade is for countries as well. So it's not just for the banks, it's not just about on lending to SMEs and making the sort of the economy work, but also in terms of the sovereign supply chains, whether that's on food imports, energies, commodities, etc. So the best case scenario for us as a bank, because of regulatory requirements and regulatory restrictions really and challenges, is to have an improved collaboration among the multilateral development banks, the DFIs, and the commercial banks. So you touched upon the first loss structures, we touched upon guarantee structures, we touched upon credit insurance as a whole. So whether that's ATIDI, whether that's AFC, Frexim Bank, I mean, all of them would help us in a bank to be able to do more, so to speak. And specifically about the role of insurance and private credit insurance and ATIDI specifically, you mentioned on that before as well about de-risking. So why is that important for the banks? Because it can facilitate long tenors, short tenors, and it can especially tackle the restrictions that we have lending into higher risk markets. Insurance is really a very powerful enabler for trade finance. I'm talking specifically about trade finance, but it's a powerful enabler across the board, really. But even in short tenors, when we have trade transactions, insurance is a powerful enabler. Why? Because with credit insurance support, banks are able to syndicate transactions, but also originate more on a bilateral basis. So it's not just about distribution on a wider scale, on a syndicated transaction, but also on a bilateral basis. It enables the banks to scale the trade book, which is something that we want to do as well. So it's not about de-risking our current book, it's about being able to do more with the limitations that we have. So allows banks to manage concentration risks, which is needed across the board. It allows banks to tackle cross-border concentrations, single obligor concentrations, and improve returns, which of course is a major discussion. It's about optimizing the risk-weighted assets, which of course, as banks, as regulated entities, we have all the constraints there. And what we see more and more, and we want to see even further, is this broader willingness of insurers and DFIs to back short-term trade as well. So I think before you would have the DFIs, not so much the MDBs, but especially the DFIs, and some credit insurers looking much more in terms of project finance and infrastructure projects, long-term transactions. But, you know, there is a need there on the short-term side as well. Yeah, I think we also touched upon sort of tiered risk structures, first loss structures that you can do even on a portfolio basis, on a transactional basis. And I think all these tools, these risk mitigation tools, are really, really relevant for us to be able, as I said, to scale the book. And I pause here and I open for questions.
Thank you very much. So I'm looking at the time. We're running a little bit late, but let's take 2 questions. And after that, I would ask you to maybe pick the brains of our experts here over lunch. So are there any questions? Yes, gentlemen, please introduce yourself as well.
Okay, Madam Moderator. My name is Dave Haban. I represent COMESA. Now, let me start by just an example. You know, we have Association of Women in Business that covers the COMESA region. And they are mainly the SMEs. And for them, whenever they meet, the main question has been the cost of borrowing capital, to the point that they believe that if they set up their own bank, they will be able to access the same capital cheaply. But we keep telling them that this is not possible because it is linked to so many other factors, like what you have said. And these women in business, they form the 70 or 65% of the women in Africa and the youth in Africa who don't need a lot of money. For them, you give them $2,000, $3,000, they will start a small business quickly. And the same people will be hiring between 3 to 4 people and keep the economy growing. But why can't we have facilities for these people who are really running the economy in Africa? They form the 60 to 65% of the African population, the youth and the women in business, and they really don't need a lot of money. For them, 3 to 4, 5,000 can attend to their needs. But we are only talking about the big capital needs, whereas we are ignoring that part of the society that need our help more. I just wanted you to be aware of it because that is the reality on ground. And how do we help them? Thank you very much.
Thank you very much. Any reactions to what we've heard?
Thank you very much for that comment. I couldn't agree with you more. Women represent, like you said, 50, sometimes 60% of the population. And they are the least, they are the most disadvantaged when it comes to that, raising capital. Now, at Bank of Industry, because we're a national DFI, our focus is to ensure that we carry everybody along in terms of the development effort. In Nigeria, we have over 39 million MSMEs. About 70 to 75% of them are women, women-owned businesses. So our calculation is that if we are able to support even 10% of that group to grow their business to an extent where they're able to hire one more person, that's about 3.9 million jobs created right there. Now, the impact on the society overall of that kind of growth, it stretches, it expands, it's scalable, you know? And so we have a dedicated group that is focused on supporting women entrepreneurs. And one of the key challenges they have always had in accessing funding is collateral. In certain countries, women are not allowed to inherit, right? So the issue of collateral is always a big one. The second aspect is capacity building as well, right? You start a small business. As the business grows, of course, your business model has to change. You have to put in governance structures, because initially when you start, you're the chairman, you're the chief marketing officer, you're the accountant, you're the lawyer. But when you begin to grow the business, then you need to put in governance structures so that the business will be sustainable. You know, so in order to access that funding, what we have done, for instance, is we have been able to secure a partial guarantee from Africa Guarantee Fund with an initial amount of $50 million. We're able to provide portfolio guarantees of up to 75% of the loan amount for our women entrepreneurs. And for other MSMEs, it's about 50%. Now, that has helped, and it comes with capacity building as well, in order to help them put in the right structures for the business to grow. The other issue, which we found, which was surprising, but we don't understand why that has not sunk into is factored into most financial analysis and all of that, is that in terms of loan performance, the women are far better than men. I am very sorry for the men in the room. I am not saying, I know I have to surrender my man card. I don't care. The truth is that, and the data shows it, the women are better managers of funds than the men. So as a bank, I want to minimize risk and all of that. Why am I not supporting this segment that is delivering? And the other thing is that that's over 50% of the population. So if you're supporting only the remaining 40 or 50%, you're fighting with one hand behind your back. You don't have everybody on the table, which is what you need to grow. So I fully agree with you. I mean, I couldn't agree more. Let's do more in that aspect. Thank you.
So do you mind if I ask you a question? Yes. In terms of, I think one of the things you mentioned, of course, the collateral, et cetera, but also in terms of governance structures, are you able to provide sort of technical assistance to them? I think that could go a long way as well.
Yes, we're able to do that. What we have done is that we have recruited over 400 consultants to cover the country, and they are professionals, and their job is to handhold these entrepreneurs, help them, for instance, to present bankable projects to the bank, feasibility studies, business plans, etc., and also help them to grow as they grow, governance structures and all of that. And we pay the fees, not the women entrepreneurs. We pay based on achievable milestones. That has helped a lot. Thank you.
Thank you very much for your question.
Follow up, yes, yeah. No, thank you very much. Now, you see, here we are talking about 65% of the population, which is of the continent. And like you said, we are ready to throw away our card, our man card. Because really these women, they are not only reliable and also pay on time, but they are the most committed. And they can work more than the normal 10 or 8 hours that we do. they work at least 12 hours. But they are the most denied people. For me, that's where we need to really focus, because they can create employment in our continent. Like you said, if you give them, at least every year or every 6 months, they can create between 2 to 3 jobs if you provide them with capital. And for me, the solution, of course, we have that bigger one, but we have to also start from the grassroots. Let's address the problems of grassroots too. Of course, we have all those things. I heard the gentleman from African Union, but he never mentioned that collateral that we are talking about. He never mentioned what do we need to do with the 65% of the population of the continent who really want to push growth and wealth in the continent. And maybe this is where we are missing.
All right, thank you very much. Incredibly pertinent question. And let's all remember as well that Africa has the highest rate of female entrepreneurs as well. So this was very, very important to mention. Do we have one very quick question before wrapping up? Or shall we go to a wrap-up? All right, let's proceed to a wrap-up then. Thank you very much to you all. And now I'd like to call on Mr. Benjamin Mugisha, Chief Underwriting Officer at ATIDI, to wrap up everything that we've heard this morning.
I think really beyond wrap-up, it's just to start with the traditional African expectation, which is to thank all of you. So I'd like to start by thanking all of you. Over the last maybe 6 or 7 years, we've always looked to say, how can we bring experts, investors, stakeholders to one table where we can have a conversation that really helps to drive innovative thought. And I hope that today's roundtable was another step along that journey. So the wrap-up is just to say that, one, we would like to thank everyone who has attended. The concept was around interactive conversation, and I think one of the things we liked was the way the interactive conversation developed over the course of these 2 or 3 hours. I would also like to thank our hosts, the Government of Angola, for putting all this together, IC Publications for coordinating everything we've done, the people who have coordinated the discussions, either as panel coordinators, I will not say moderators, as participants, and also yourselves as attendees. So on behalf of the management of ATIDI, on behalf of myself and my team, the underwriting team and the comms team at ATIDI, as well as the organizers and the staff who are online, I'd just like to say we do value the partnerships that we have. We have seen that there are local partners and DFIs on the continent who are working to provide solutions for the continent. I think we've also heard from the governments around risk participation and risk assessment and how international risk perceptions do impact this continent. We've also heard from financial institutions talking about how constraints sometimes do not reflect the reality of their impact and how more could be done if there was more level playing field. And then we've heard from the institutions that try to provide a fair representation of the risk profile relative to all other institutions on the globe. And I think here we're talking about rating agencies. And I think that was all very useful, because what we're trying to do when we have these frank dialogues is to actually provide perspectives. So you've seen the perspectives from all these different participants, so that we can see how these perspectives can be moderated. ATIDI is a risk provider and therefore mitigated where we play a part, so as to reduce the cost of capital. My closing statements would be, the work we do is about livelihoods. It's about, the small and medium entrepreneur, the young African who is looking to the future to see if they can have meaningful, productive contribution to the lives of the people they love. It's about governance and the structures that we are actually trying to ensure there's transparency in information. It's about regional integration and trade on the continent. It's about infrastructure development and financing. It's about mobilizing private capital, and that's why we have our partners from the London market who actually sometimes are left behind in this discussion, and yet they are important investors as well, and how this entire blending of capacities helps to deliver to stakeholders, the governments, and the people on the continent real value add through innovation at a sustainable, in a way that is sustainable. So thank you, all of you, for being part of this conversation. We promise to continue to see how we can create these forums for continued discussion. And I would really say maybe a round of applause to all of us for having taken the time to be here. Thank you so much. I think in the afternoon we will have some continued dialogue, so maybe I'll hand back for a conversation around that. Thank you.
Thank you so much, Mr. Mugisha. That was a perfect conclusion to our talks here this morning. So very, very briefly, let's all have lunch on the 24th floor. Please be back here in 1 hour, in fact, at 2 p.m. sharp for our country's presentation. And we'll make sure that we finish at 3:15 on the dot as well. So lunch until, well, something to 2 p.m. and we'll be back here at 2 p.m. on the dot. Thank you to you all.
Ora viva. Alô. 1, 2. Teste. Good morning. Alô. You okay? Yes.
Ligue agora.
Yes.
Testing. All good?
Angibana kisene kumbunda, Angibana kisene kumbunda, Kai, 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 Mokilo bokwesa mosha inama, Kai, 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 Mokilo bokwesa mosha inama, Iri fangana kalabaya kabiri, Iri fangana kalabaya kabiri, Angitala nangika yetunda, Angitala nangika yetunda, Kai, 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 Mokilo bokwesa mosha inama, Kai, 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 Mokilo bokwesa mosha inama. Kai, 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 Mokilo bokwesa mosha inama, Kai, 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 Mokilo bokwesa mosha inama. Idi fangana kalambaya kabiri, Idi fangana kalambaya kabiri. Yo so kingi bita, o mundo lozoka jivunda. Yo so kingi bita, o mundo lozoka jivunda. Kai, 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 Mokilo bokwesa mosha inama, Kai, 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 Mokilo bokwesa mosha inama. Idi fangana kalambaya kabiri, Idi fangana kalambaya kabiri. Mulenge ungibusa kulikunda, Mulenge ungibusa kulikunda. Kai, 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 Mokilo bokwesa mosha inama, Kai, 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 Mokilo bokwesa mosha inama. Idi fangana kalambaya kabiri, Idi fangana kalambaya kabiri. Yo so kingi bita, o mundo lozoka jivunda. Yo so kingi bita, o mundo lozoka jivunda. Kai, 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 Mokilo bokwesa mosha inama, Kai, 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 Mokilo bokwesa mosha inama. Idi fangana kalambaya kabiri, Idi fangana kalambaya kabiri. Mulenge ungibusa kulikunda, Mulenge ungibusa kulikunda. Kai, 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 Mokilo bokwesa mosha inama, 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 Kai, 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 Mokilo bokwesa mosha inama.
Meu amor, teus lábios um sabor, teu olhar sem lamento, passado tanto tempo, teu gesto de andar, teu corpo um movimento de um sábio esperar. Meu amor, meu amor, teus lábios um sabor, teu olhar sem lamento, passado tanto tempo, teu gesto de andar, teu corpo sabido esperar, esperar. Meu amor, meu amor, meu amor, minha chuva perdida por entre o meu chorar, minha abelha caída e o meu mel a cantar. Meu amor, minha chuva, meu mar. Oh, 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 oh. Meu amor, sem o medo dos aromas da fruta, da paz que não desfaz, as vitórias da luta, do amor sobre a guerra. Meu amor, meu amor, meu amor, minha terra. Meu amor, minha terra. Meu amor, meu amor, meu amor, minha terra. Nas feridas do seu parto, a raiz do nosso umbigo, beberão a seiva e do ventre da mamã terra germinarão as sementes das nossas certezas e nos embriagaremos da carne dos seus frutos. As crianças nascerão sem metas nos olhos e as suas mãos sujar-se-ão com mel do nosso olhar. As crianças serão crianças, negras, loiras ou brancas, serão pétalas da mesma flor.
Das feridas do seu parto, a raiz do nosso umbigo, beberão a seiva e do ventre da mamã terra germinarão as sementes das nossas certezas e nos carne dos seus frutos. As crianças nascerão sem metas nos olhos e as suas mãos sujar-se-ão com o mel do nosso olhar. As crianças serão crianças, negras, loiras ou brancas,
da vossa e minha é mesmo como os seus panos, já não tem a cor berrante que tinha nos outros anos. A vossa está velhinha, mas de manhã, manhãzinha, pede licença ao reumato e não passo nada prático, rasga as estradinhas na areia, rasga as estradinhas na areia, lá vai para o cajueiro, que se levanta altaneiro no roteiro dos caminhos, das gente que vão para baixo, nem criados, nem padreiros, nem alegre lavadeira, desta nova geração, das avenidas de Alcatrão. Ó velho fraco, pregão da velhinha quitandeira, ó velho fraco, pregão da velhinha quitandeira. Mamauê, quaque, maquezo, maquezê, quaque, maquezo, maquezê, quaque, maquezo, maquezê, quaque, maquezo, maquezê. O pregão da vossa e minha é mesmo como os seus panos, já não tem a cor barrante que tinha nos outros anos. A vossa está velhinha, mas de manhã, manhãzinha, pede licença ao reumato e não passo nada prático, rasga as estradinhas na areia, rasga as estradinhas na areia, lá vai para o cajueiro, que se levanta altaneiro no roteiro dos caminhos, das gente que vão para baixo, nem criados, nem padreiros, nem alegre lavadeira, dessa nova geração, das avenidas de Alcatrão. Ó venho fraco, pregão, da velhinha quitandeira, ó venho fraco, pregão, da velhinha quitandeira. Mamauê, quaque, maquezo, maquezê, 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 quaque, maquezo, maquezê. Maquezo, maquezê, quaque, maquezo, maquezê. Quaque, maquezo, maquezê, quaque, maquezo, maquezê. Maquezo, maquezê, quaque, maquezo, maquezê. Quaque, maquezo, maquezê, quaque, maquezo, maquezê.
Boa tarde. Rebonjour à tous. Good afternoon. I hope that you enjoyed your lunch. So now we move into one of the most strategic segments of our program, the country investment briefings, where investments meet opportunity. Today we'll hear directly from two countries that are pushing the boundaries of reform, development and resilience and are actively opening doors to partnerships. You will be given insight into each country's macroeconomic outlook, flagship projects and funding opportunities, crucial intelligence for investors looking to make meaningful impact on the continent. And we'll begin with Angola, a nation on a transformative path, making bold moves in privatization, infrastructure, and critical minerals. So let's dive into seeing how this country is reshaping its investment landscape. And to do so, let's all welcome Mr. Bruno Batista, Head of Promotion and Private Investment at APEX, that's the Angolan Private Investment and Export Promotion Agency. Round of applause for Mr. Batista.
Good afternoon. Good afternoon to everyone. First and foremost, I'd like to thank the hosts to invite us, for inviting us to talk a little bit about what is IPEX, the support that IPEX gives to the private sector at national and international level. I'll start with a topic that says why invest in Angola. The Angolan market is an emergent market with a big potential for growing, with favorable policies for private investment, a huge population that is growing. We have youths, and the country is located strategically to be a hub in the region. It is important to note that by investing in Angola, investors will have access to a market that is not only national, but a regional market with highlights to the DRC that has almost 80% of consumers. So by its own, this represents a big opportunity to invest in Angola. It is important to say that the country has resources or natural resources. We are talking about forest, sea, arable land, and also the country has almost 38 of the 50 crucial minerals for the industrial sector. Besides that, the priority sectors that were identified in the private investment can substitute the importations that currently for the productive sector or the food sector is almost $1 to $2 million. So we have here a huge opportunity to invest in the national production because the government is interested in increasing the national production and decreasing the exportation levels. We have programs One of them is PODES, that is a very important program that contemplates different lines of financing, and the main objective of this program is to increase the national production as well as diversifying the exportations. The exportations or national exportations, Angola today is 90% or 90% of the exportations are from petroleum. So we have this challenge from IPEX and the government so that we can diversify our exportations. So in the past few years, the government has been implementing some reforms to improve the environment, the business environment. And at private sector level, IPEX was part of these reforms. In 2018, we had different entities that were dealing with private sector investment. So the result from these reforms was the creation of IPEX. So different institutions that were dealing with topics with regards to private sector investment created the IPEX so that when investors come to Angola, do not have the need to contact different institutions, and everything that is topic related to private investment was to be dealt with IPEX. So with the creation of IPEX, we could send all investors to the organs of public administration. As another result of this reform, in 2020, we created a single window of investment that is an operational model that give powers to IPEX to, on behalf of the investor, deal with some issues. For instance, questions related to visas, questions related to licensing, questions related to land. So the main idea is to make the investor focused on the implementation of the project. The other aspects that are related to services, public administration, IPEX is the body that was created to support and to have a green channel besides the main institutions or public institutions, so that in a speed up way and within the stipulated time, they can be able to get the responses from the investors. As another result of these legal reforms for the business environment, the law of private investment in 2021 had a small alteration with the introduction of the contractual regime. So the contractual regime is a regime that gives the possibility for the investors or private investors to negotiate the fiscal benefits and other facilities for the project with IPEX, the taxation authority, and other institutions that may be relevant to the project. In the same manner, in a judiciary manner, sometimes some projects have litigation situations, so there is a need that the investors may acquire alternative manners in order to see their issues solved. We are talking here about intermediation and negotiation. So it's also important to know that in 2022, how can I say this? We created code for fiscal benefits, that is an instrument that is aimed to give more warranties and benefits to investors. And I'll be talking or expounding with more details on this later in the next slides. So through a presidential decree, Angolan government exempted almost 98 countries that do not have the need to obtain a visa, a tourist visa, in order to visit our country. I hope that some investors present in this room were also contemplated in this regime that we created in 2022. So these are some of the reforms. However, other reforms at macroeconomic or fiscal levels were also implemented since 2018. So, well, IPEX, as I mentioned earlier, is an institution of the Angolan government, and this agency has two core missions. The first is to promote the investment in Angola and attract investment. And the second role is to support national companies to export their products, and also the companies that aim to put their services at international levels. IPEX has the role to give support. It may be through contacting potential customers or partners in the diaspora, or support in the elaboration of market studies through national entrepreneurs. And the requirements to export and to internationalize their services. So these are the main roles of IPEX. In terms of opportunities or investment opportunities, well, in a joking manner, I say that Angola is a virgin country. We have opportunities in all sectors, or almost all sectors, I can say so, and I can highlight here some sectors like agricultural sector. We still import. In terms of food sector, we still do lots of importation. In my first intervention, I mentioned that we import half to 2 millions of USDs in terms of food sector. So this is an opportunity for us to scale up. When we look at tourism sector, we have different landscapes. We have some assets here at the level of privatization program. We have different assets that are said to be privatized. I have mentioned here about the visa exemption. We have almost 98 countries. So this is something that will contribute to the increment of tourism in our country. So in terms of construction and infrastructures, I would like to highlight a project that is very important, not only for Angola, but also at regional level. We have the Lubito corridor. So I won't be giving many details with regards to this infrastructure, but in general manner, for those who do not know Lubito corridor, it's railway. It's a railway that starts from Lubingo port up to the border with DRC. So we have, for almost 2 years, the Angolan government, through a concession, had a pool of 3 companies that make the management of this corridor. So through this corridor, we have many opportunities. We have logistical centers. We have investments in agricultural sector, investments in the mineral sector. So it is a very important infrastructure to ship local goods as well as importation of raw materials. So it is important to highlight at investment or investor perspective, it is important to subscribe the products in IPEX so that we can give necessary support. And by doing the subscriptions through IPEX, investors have access to different fiscal benefits, and the low fiscal benefits has three lines. So we have benefits that are contemplated in this regime and are applied to the projects that are not contemplated in the primary sectors. We are talking about trade, extraction of products. So the Code of Financial Fiscal Benefits defines which type of benefits to attribute to this line of products. So we have a special regime that is applied to the projects of the priority sector. We also have the contractual regime whereby for the projects to be in this regime, they need to meet 2 requirements. The first requirement is the value or amount of the investment. We are trying to say that the investment has to be budgeted at around $10 million and to create 50 jobs to national residents. So an investor has the possibility of negotiating the fiscal benefits for his project. Unlike other regimes that I mentioned, the other regimes do not give negotiation terms of the fiscal benefits depending on the area, the province that the project is being implemented. The code defines the incentives to be applied to the project. So on this slide, it is only to identify the taxes that have fiscal benefits. So we have the property for the acquisition of real estate, we have application of capital, and we have stamp tax. So in the following section or column, we have the period where we can be able to use this, and also the reduction tax. So we have here the fiscal benefits for the projects in the special regime or in the priority sectors. Depending on the area, province, or zone that the project is going to be implemented, we have here different limits or reductions for the same. And to make a reference or an example, a project in the agricultural sector that is being implemented in the Luanda province, it is contemplated in the zone A, and we have a reduction of 20%. And for this tax, they can be able to benefit from this for a period of over 2 years. But if this project is implemented, for instance, in the interior of the country, for instance, in the Kunene province, Kunene province is in zone C. We have a reduction of almost 80% for a period of over 80 years. So this is the difference between the 4 zones of development. So we also have the contractual regime that I referred to previously. The investor in this regime has the possibility of presenting or making a proposal of the best benefits for his project, and through a negotiable basis, we have IPEX and the General Tax Administration, where we discuss the best benefits to be attributed to these projects. It is important to say that besides the fiscal benefits, we also have customs benefits for those projects that has the need to import machines, equipments that are needed or essential to implement their projects. So these are exempted for the custom payment. They are only required to pay VAT, but the modes of payment can also be facilitated and negotiable. So in a general way, or generally speaking, this is what I had to present. And I am available to any doubt or any question that you might have. Thank you very much. I don't know if anyone has a question to pose or if everything has been said, but I'll be here up to the end of the section. If you don't have any question for now, we have a question over there. Please have the floor.
Thank you very much for your presentation. Just a question as to Angola's programs with regards to carbon credits. Can you speak to that a little bit? Do you? Oh, sorry. What are the country's programs with regards to carbon credits?
Muito obrigado.
Thank you very much for your question. So this topic of carbon credits is a matter that we received different investors interested in this topic. However, at the moment, from what is the knowledge of IPEX, we still have the need to create a legislation so that we can define how the government will implement or deal with this topic. At the moment, we don't have a legislation for this topic, and that is the reason why. And it is a matter that the Environment Ministry or Natural Resources Ministry will be able to address and give more concrete information. But in case of need, we can also have a special agreement with these institutions. Thank you.
Presentation.
Hi, Zan. Yeah. Hi, thank you very much for your presentation. You gave a long list of the tax incentives available to separate industries. Is that uniform across the board, regardless of nationality of the investor? And And have you had, since those have come into play, has it resulted in an uptick in investment?
Well, the fiscal benefits are attributed independently of the nationality of the investor. If the investor is national, international, from South Africa, Kenya, United States, we don't have a differentiation in terms of origin of the investor. So we give based on the project and not on the nationality. Yeah. If we don't have more questions, thank you very much for your attention. But after the session, we will be here to continue our discussion. Thank you.
Thank you very much, Mr. Batista, for such a compelling presentation. And I think that we heard Mr. Batista very loud and clear. Angola has potential, is ready to do business, and Apex is here to help. Thank you one more time. So now we turn to Senegal, a country that continues to impress with its strong growth, economic reforms, and visionary planning, with mega projects like the 1.2 billion Dagné port and the Train Express Régional. Senegal is not only thinking big, it's building big. Let's now hear from the countries and its plans to take investment partnerships to the next level. And let's welcome to do so Mr. Amadou Birahim Gueye, conseiller technique du ministre des Finances et du Budget du Sénégal. Bienvenue, Monsieur Gueye.
You will need translation. Well, good evening, everyone. I would like to start my presentation by thanking ATIDI for the opportunity given to us, to the people of Senegal. The Senegal you know already. We have projects that are ongoing. And these are sources of opportunities for investors. The previous speaker talked about the agency of investment. He said, I can say that what he said is related to what Senegal is proposing as well. Because we have created this institution in year 2000 just for promoting investment. Slides, please. We chose to talk about strategies that are put in place by the authorities so that the country may develop. Good. This is the presentation of Senegal. We have a stable political regime.
it is a country that has strong institutions, and we have had 3 democratic governance. I'm going to come back on that. But also Senegal is a member of regional institutions, and this is very important for us because these organizations are strengthening the stability of the country. We have the ECOWAS, and then we have investors coming because of ECOWAS, because we have this big market with ECOWAS. To those organizations, bodies, we have other organizations and legal area. These are institutions and regional institutions that are strengthening the stability and the capacity of Senegal. Economically, the important information is the oil production to begin in 2024 and gas production in 2025. This is what is putting Senegal among the oil-producing countries, and is going to allow that we project a growth of 8.8% for 2025. And this morning there was a presentation to 8.4, but we are now at 8.5, and then we project that to 8.8 in 2025. I was saying that we have strong institutions, and in March 2024 we have new authorities after the elections, and then we have a vision of 2025, and then it's called the National Transformational Agenda, Senegal 2050, that wants a sovereign Senegal, prosperous Senegal. This is the new vision of the new authority. So we have a master plan for 10 years, and this 10-year master plan, it has five-year plan each. So we started with 2025 to 2029 with the overall objective of promoting endogenous and sustainable development driven by responsible, viable, and competitive territories. This strategy, national strategy of development, we have 4 main areas, like competitive economy. Secondly is quality, human capital, and social equity. And the other one is sustainable planning and development. And 4th, good governance and African commitment. From the competitive economy, we have developing growth engines, competitive territorial hubs, within this competitive economy, we want to develop growth engines in competitive territorial hubs, and we have identified growth factors like the extractive industries, agri-food manufacturing, and high-value-added services. High-value-added services. The new government has developed a new policy framework so that it unlocks the Senegal economic potential. So we have projects that have been developed by new authorities with a number of measures that aims at attracting investment So we have the reform of the investment code that is going to make the regime an exceptional regime. By strengthening research and innovation, we are going to come back on that because this strategy elaborated by authorities is just referring to another strategy of the New Deal of technology and industrialization of the country. A strategy for productive sectors, so we mentioned lately the mines, and the review of administrative procedures, revitalization of special economic zones and agro-pools, because these zones are put in place for investors, for the investors coming interested in the country. So there is an agency that is in the country in charge of investment in the country. You can go to investinsenegal.se to go to find that now. That one. So these are clear projects. I think we talked about a number of projects. We can add the port of Ndaya that has been added. In this presentation, we have a few projects that you can see here, but with Invest in Senegal, you can see a comprehensive list of projects. So it means that with development, I'm going to tell you about the structuring of industry of petrochemicals. As I said earlier, Senegal is producing gas. So there is a project of having a network, creation of a network, a company that creates oil and gas. So we have a strategy that is in place. We have transformation of ABD into African Airport Hub as well, which is one of projects. So ABD is a company that is in charge of creating the hub. So we transform the existing airport into the bigger airport that is going to be an airport hub. I was saying that Senegal has started the production of oil. So Senegal is now integrated. Now we are talking about three main projects of gas. There is Sangoma project, which is a project located in an offshore field, and then the production of the oil concerns more than a third of Sangoma oil's potential. So we have another project with Mauritania. It is a Senegal-Mauritanian gas project in the Tato Basin. So the resources are estimated at 15 TCF distributed between Senegal and Mauritania. So the project started in January with the first shipment done in April 2025, and it's generating resources. We have a project that is being developed, Yaka Teranga project, and it is led at 90% by Cosmos and Petrosen 10% of shares, which can go up to 35%. And then we have mentioned the oil and gas production, because these are resources, sources of revenues, because we mentioned of 8.8% growth, 3% come from oil and gas production. And then we expect 73 billion, 88 billion in 2026. So this is what is related to the oil and gas production. Now, regarding the mines, Senegal has a strategy that has been developed to coordinate this industrial sector. The idea is to define and to update the policy, to develop a plan to review, update the mining policy and the regulation, and we have identified two sectors, which is a gold sector of gold production that is in some areas of Senegal. So the first exportation of Senegal with the three main activities like Sabdala, Mako, Karakena, which together produced 12 tons of gold in 2023. It is important to say that those companies of mining produce revenues also for the shareholders. Also, we have a dynamic heavy mineral industry. There is an important project that we have as a regional mining hub, which is a cross-strategic initiative to stimulate growth. The idea this project has a value of 330 billion of francs CFA to be financed by the private sector, and the objective is just to transform Senegal into a reference point for mining operators established in West Africa by providing with the necessary equipment, services, and human resources. I mentioned the hydrocarbons, but we have a strategy also that is called phosphate strategies. Because Senegal also produces phosphates, in the north, in the area of Mada. So the phosphorus that is produced in Senegal, it must be exported. So there is a strategy that has been elaborated by the Ministry of Industry, and then we had a presentation in the cabinet. So the idea was to find out how we can maximize the creation of wealth with phosphate resources. So the government would like to develop an industry to strengthen or transform phosphate as a central element. So the projection is to create a company, a holding, a state holding that is going to do a phosphate development, so that we can do the transformation of phosphate. The idea is to create 4 business units for the mining production, also production of ammonia and urea. So this is, in a nutshell, the mining strategy, especially the phosphate strategy that is being developed with clear objectives to produce really products that can come from the transformation of phosphate. The last strategy on which I'm going to present is digital strategy. Following the adoption of 2050 vision announced by the President of the Republic, the new digital strategy is called the New Deal, Electronic Deal. In that area, in the framework of the New Deal, the technological New Deal, in that New Deal, we would like to create a digital company that provides services towards 2034 with the first master plan 2024. Our ambition is to have a digital society, a country of high value added services. This strategy, it has 4 components. First is digital sovereignty with the objective of ensuring technological independence. Second, digitalization of public services, modernize administration by democratizing services, developing of the digital economy, and to make Senegal the African leader in the digital technology. So there are 12 priority programs that you can see. I am not going to read them. Maybe we need to identify in those 12 programs. One of those programs has been evaluated, and there is with the identification of funding, and the funding that must be searched from many sources so that they can be implemented. So in addition to the strategies that exist, we have an attractive environment for investors. As I mentioned, we have reforms that are ongoing for investors, and we have a new tax code that is giving some advantages to investors to develop their investment and incentivizing investors. So this is what I had planned to share with you. You are going to see that I didn't talk more on the agency managing the promotion of investment. Our objective was just to share the strategies that are put in place by the authorities so that we can develop Senegal, because each and every investment that must be there must follow the Vision 2050 that has been divided in a master plan, also a 5-year plan. And then we need, of course, the funding. We need a funding of 12 billion of francs CFA, which is also expected to come from the private sector and other partners. So after the strategy 2050, we have another industrial strategy to develop the industrial sovereignty, so that we can develop the mines instead of exporting them. And then we have also the digital strategy so that we can have high value added services by 2034. So I'm still here for questions. So there is another colleague who is in Senegal, who is a specialist of the finance. So if you have question about finance, he would be the right person to talk to. Otherwise, I'm still here just for question. Thank you.
Le premier intervenant.
The first question, there is no one who has a first question. Second person to ask a question, there's no one.
You referenced the Pangaea presentation this morning. Oh, sorry. Yeah. Yeah, you referenced the Pangaea presentation this morning, which showed the growth rate almost halving from 8.4% or 8.8% down to 4%. Are you in agreement with that change, especially given the continued coming on stream of the oil and gas sector and some of the mining industries you talked about as well?
Désolé peut-être pour la traduction, j'ai raté quelque chose.
I took the translation late. Can you repeat the question so that I can get it from the beginning? May you repeat the question?
You referenced the presentation this morning saying where the growth in Senegal in 2025 of over 8%, and they had that the growth rate was going to fall to below 5% in 2026. Are you in agreement that it will show such a steep drop-off, especially given the continuing coming online of some of the oil and gas projects and some of the other projects you just mentioned?
Je vais essayer de répondre même si j'ai pas bien entendu.
Maybe I'm going to try to answer. So the idea, the 8.8% is a projection. It's a projection. So the projection that was made first in the morning, this was a projection by the World Bank. The World Bank has projected it to 8%. This was based on the performances of the past years. So depending on that, that's when they said that just the growth was just going to be reviewed to be lower.
Thank you very much for your presentation. You mentioned you have a colleague on the phone, is that right, who can speak to financial queries?
Hello?
Hello? Oh. Okay, great, thank you, thanks. So my question is perhaps a tricky one, but I think it may be an elephant in this room with a few of my colleagues in our sector, which is regarding your relations with the IMF and handling the larger debt burden that you have inherited from the previous government. And I think everybody appreciates this is something that the new government has had to audit and now handle in a disciplined way. And I just was wondering if you could perhaps give us a sense of how the negotiations are developing with the IMF for a new program. Thank you.
Thank you. I don't know whether my colleague oh, he's there, right. My colleague, Patmoud, is connected. Maybe he supplied me with some information, but I think that he should intervene directly because he's taking part into the negotiations right now. Yes, good afternoon. Do you hear me? Well, yes, we hear you. Yes. Yeah, good, good. Now, let me answer to the question that has been asked in English regarding the negotiations underway with the IMF and with all the efforts of resource mobilization. Well,
I would say that the engagement and the conversations with the IMF are going well, and they have been constructive so far. We hope in the next few weeks to be able for the IMF to go to board on the misreporting case. And in the next month or so, we should be able to finalize a new program, as was announced by the Minister of Finance and Budget. So I think there's a very strong alignment between what Senegal is doing and the reforms and the measures that the IMF is looking for us to implement as well. There's very clear alignment on the fiscal consolidation pathway. We have already started working on specific measures on energy subsidies, on rationalizing recurring expenditures, and also being more selective on investment projects in order to reduce our deficit level. So our target for this year is to bring down the deficit to 7%. Next year, we plan to reduce the deficit down to 5%, with an objective to reach 3% of deficit by 2027, which is the sort of convergence criteria in the YMO region. And I think that's exactly what the IMF is looking forward for us to do. So we have alignment on that, and we are progressing on negotiating a new program. And with respect to our financing plan, we have been able to roll out our financing plan so far with great success. A couple of months ago, we had a large bond offering in the regional market where we raised close to 620 million euro. Yesterday, we have launched a new public bond offering in the regional market where we will raise at least 300 billion in local currency, in addition to other financing efforts that we are deploying with other partners as well. So we have a very resilient financing plan for the year, and obviously finalizing the discussions and the engagement with the IMF in the next few months will be also an important step for us, and we look forward to finalizing that.
Thank you very much. That's been very helpful. Appreciate it, and applaud you on all those efforts.
Merci, Pape Moda.
Thank you, Pape Moda. All right. I would like to take this opportunity to hear any relevant questions that you have. As I said, we are just at your disposal, knowing that beyond this presentation, there are maybe a number of questions you may need to talk about. Well, we have the different sites, a site for investment, promotion of investments. So I thank you. If you need any more information, you can check on our websites. Thank you very much.
Merci beaucoup, Monsieur Gay.
Thank you, Mr. Gay, and we thank the special advisor to the Minister of Finance, Mr. Pape Modaloum, who actually intervened online. So,
brings us to the end of 3 extraordinary days here at the 25th ATIDI's annual general meetings. And before we say goodbye, it's my pleasure to now call for the last words Mr. Benjamin Mugisha, Chief Underwriting Officer at ATIDI. Let's all welcome Mr. Mugisha.
Thank you. Thank you so much. I think, although we said we've come to the end, we actually just wanted to announce that there is still one thing to do, which is we have to see the lovely city of Luanda. So there's an excursion tomorrow. I hope you all received the email And if you didn't, my colleagues at the back, Sheila and company, will be more than happy to support through that process. We'll be meeting at 8:30 for those in this hotel and 8 o'clock for the hotels that partnered with us for this AGM. We'll be going round to see everything like Luanda Bay, National Bank, Slavery Museum, and please make sure that you're there. We'll then end that session with a lunch at Epic Sana restaurant. Don't worry about language. There will be someone to translate across all the languages that we know have been spoken by our guests. So we just wanted to say, yes, it's the end of the roundtable, but it's not the end of the AGM. We still have the great opportunity to see the lovely city that we've been hosted in. Otherwise, on behalf of my CEO, the management at ATIDI, the board members and the chairman, our shareholders who have sat through this session as well, and we thank them for that support. As well as on the behalf of all of you, I would like to, as I said at the beginning, start by, as we do as Africans, thanking our host for hosting us here in this very lovely place, and maybe we give them a round of applause for that. And then, thank you. And then also to thank all of us who have been here. Thank you so much for the support. We look forward to seeing you again in the near future. I think we were all given an assignment recently to learn a few Spanish words, but I said to my colleagues, I'm very worried that I might say farewell, mucho, obrigado, and I say thank you, ciao. So I just want to say it's really been a pleasure learning about the culture of this place and for the hosting that you've done. And we hope to see you again in the near future. So ciao, which I know means bye-bye, and look forward to seeing you again in the near future. Thank you.